All right, we will call our August meeting of the State Investment Council to order. Could we please call the roll?
Commissioner Stephanie Garcia Richard, Treasurer Laura Montoya, DFA Secretary Wayne Probst, Nick Teas,
Present.
Catherine Allen, John Bingaman,
Present.
Kelly O'Donnell,
Present.
Alan Sanchez,
Present.
Kurt Sommer,
Present.
Mary Roman. That's 7 in the affirmative. We have a quorum.
Okay, thank you very much. The first item on our agenda is the approval of the agenda. Is there a motion to approve the agenda?
Second.
Okay, we have a motion and a second. Could we please take a roll call vote?
Treasurer Laura Montoya, Nick Teas,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Sommer,
Yes.
Mary Roman. 7 in the affirmative. Motion passes.
Okay, and next item on our agenda is the approval of the SIC minutes from June 23rd, 2026. Is there a motion to approve the June minutes? Motion and second. Could we please call the roll and take a roll call vote?
Treasurer Laura Montoya, Nick Teas,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Sommer,
Yes.
Mary Roman. 7 in the affirmative. Motion passes.
Okay, thank you very much. We will now move to section 2 of the agenda and begin our reports with our State Investment Officer report. Mr. Clark.
Thank you very much, Mr. Chair and members. Good to see you this morning. I got a handful of pretty quick updates. First, I'd like to go over some internal staffing updates. We recently welcomed Dante McGee. Dante, please raise your hand to our team. He's an investment operations analyst, and so he's working with us under Don. As well, we have a couple of people transitioning roles. So Katrina Rose, Katrina, please raise your hand. She has been promoted to Communications and Records Officer. And then Bruce Brown isn't in the audience with us at the moment, but he has transitioned away from his original role in the private equity team and is now a portfolio manager for our systemic risk function. As well, I want to highlight that Anthony Sofinos on our accounting team has recently earned his CPA, so congratulations to Anthony. Also, you got to meet a couple of our interns a couple of meetings ago. We hosted a total of 4 interns this summer, and that was a really fantastic experience. This is something we plan to do on an ongoing basis so that we both can try to recruit some experienced people into the organization, but also give people a chance to come in early on in their career and potentially stay with us and grow over time. We've been participating very actively in a variety of community engagement functions. As you are very well aware, many New Mexicans are hearing for the first time that New Mexico has a sovereign wealth fund, has $75 billion, and many of them don't understand what we're doing with it. There's a common misperception that the money is literally just sitting there. So we are really working on an educational campaign to inform everyone of what we're actually doing. I presented to about 150 people at Economic Forum in Albuquerque recently. That went well. It was great to see so many people attending that. That was the most attended event that Economic Forum has had this year. I also presented last night at Albuquerque Indivisible. I'm not quite sure how many people were there, but it was a pretty full room. And some members of Albuquerque Indivisible had been talking about SIC, but were looking for additional information, wanting to know how we were using these funds and what could be possible. So it was a good dialogue with them last night. Also, just want to announce that the Pacific Fusion groundbreaking is happening today. Unfortunately, you and we aren't able to attend because it is happening right now. So it's unfortunate that it conflicts with this meeting. We do have our marketing manager, Molly Callahan, representing SIC at that function. Also, just want to highlight that coming up soon is the annual Governor's Conference on Economic Development. That's going to be happening the first couple days of September next week. And that's a really good event to attend if you have time on your schedule. You'll see representatives from economic development, communities, and businesses from across the state attend that conference. And both Chris Cassidy and I will be participating in presentations and panel sessions. Also coming up is an event called Building an Advanced Energy Ecosystem. This is something put on primarily by Representative Meredith Dixon. And it really takes a nonpartisan look at what New Mexico's energy future could look like and how to make sure that New Mexico remains a leader in energy development during the transition. Also coming up in early October is the Roadrunner Technology Forum 2026. I think we'll probably send out a special email to all of you about this with details, because this is a great forum. It really just keeps getting better every year. And the last couple of years, they've had over a couple hundred people attend this. We've had people from other states come in to attend this forum. If there is one forum related to what we do in the venture capital ecosystem that is worth attending, it is this one. So we'll make sure to send you information on that. And then also, as we know, we're going to have a new governor, a new land commissioner. And so we're in the process of meeting with the candidates of both parties for both of those positions to make sure that they understand coming in how SIC works, what we're doing with the funds, so they're not hitting the ground on day one with no knowledge of SIC. So all four candidates have been interested in having those meetings and hope to wrap those up within the next few weeks. And with that, Mr. Chair, I'm happy to answer any questions.
Thank you. Any questions for our State Investment Officer?
Oh, and Mr. Chair, one thing I forgot to mention is Katrina will be sending out an email to council asking for early RSVPs for our regular November council meeting. We're just looking to see whether we're going to be able to hit quorum for that meeting so that we know whether we will be able to bring investments at that meeting. It is the week of Thanksgiving, so we understand if people aren't available. But if you could please just give us a very early heads up so that we can plan around whether we have quorum or not. But thank you, Mr. Chair.
Okay, thank you. Any questions, Madam Treasurer?
Good morning. Good morning, everyone. Couple follow-up because we didn't have a meeting last month. So Katrina, congratulations. Dante, welcome. I'm assuming Katrina's new job is the IPRAs as well. Okay.
Yes.
And then congratulations to Anthony. How many people do we have in staff? How many more are you looking at? You mentioned something at IPOC on requesting so much money for more salaries for this fiscal year. Can you give us just a rundown of whatever you presented to IPOC?
Yes, Mr. Chair and Treasurer. So at the moment, I believe we were at 42 employees. We're authorized for 49 this year. I think we will hit 49 before the fiscal year ends. I mentioned at IPOC, which for those of you who don't know, is the Legislative Investment and Pensions Oversight Committee, that we are still very understaffed. When Ascension took an updated look at our staffing levels compared to those of our peers, we have made some progress, but our peers are still staffed at more than 50% greater levels than we are, given the amount of money that we manage. And that is the case whether you look at our peers in state of ERB and para, or whether you look at our peers in other states. Either way, we are staffed significantly less than they are on a per AUM basis. In looking at what it's going to cost to both staff up and pay market rates, it's effectively an additional $7 million beyond our current staffing budget, which is just a hair under $12 million. So I mentioned at IPOC that that's something that we would be asking for. Now, the budget request system won't let us actually get to that point. We can't enter over a certain number of positions into the system. We can't enter in the salaries that we think we will actually need to pay. It forces you into midpoints. So we are putting about a third of that $7 million into the request, and Brent will cover that in a little bit more detail during his section. But the rest of it, we think we have enough flexibility with our budget adjustment request authority. So if we get that, that third, then we think we'll be in a good place to be able to have the funding to staff up next year.
And I'd like to jump in. We are actively recruiting 7 positions, a budget analyst, 3 investment analysts, and 3 investment portfolio managers.
And Mr. Chairman, on that point, where are you guys publicizing these positions? Or are you using someone to help out?
Primarily on LinkedIn, Kevin and Kristen are actively going through LinkedIn and reaching out proactively. We are also posting it to all of our social medias and encouraging staff to post it to their social medias as well.
Mr. Chairman, is it also on state personnel website?
Mr. Chair and Treasurer, they will not allow us to post because they're not classified positions. They will only post classified jobs.
Mr. Chairman, I have asked them to do it for me for exempt positions and they have allowed. So maybe, maybe not because you have so many more. How many classified versus exempt do you have in total?
We have 1 classified employee, everyone else is exempt.
Okay. And then, Mr. Chairman, how much did you have in reversions? Do we know yet?
Mr. Chair and Treasurer, I will turn to Brent for that.
Madam Chair, that's a $1 million question. We're still working on finalizing all of our audit adjustments, but at this point in time, fiscal year 26, we had bars of close to $26 million, and we're probably going to revert back about $3 million of that.
And Mr. Chairman, that was my next question is, how much in bar authority? Okay, thank you. That's all.
Thank you. Additional questions on the SIO report? Anyone online?
Actually, Mr.
Madam
Chairman, there
Treasurer.
was one more thing.
Yep.
I don't know if John wants to talk about it or not, but there was some I don't know the right word. There was some comments made by some of the IPOC members related to our video. And I think maybe we should put that on the record. And the reason why I think we should put it on the record is because I believe this council gave some guidance to John as to educating people why we are not the right people or fit to invest into the situation with PNM. And so if John could just put it on the record.
Absolutely. Mr. Chair and Treasurer, this is a topic that came up at IPOC, and it's also a topic that is coming up at every presentation that I give. Obviously, the potential purchase of PNM by Blackstone is causing a lot of discussion around the state. A few of the key points that I make sure to mention in each case are, first, that the state constitution prohibits us from doing that at the moment because we can't purchase more than 10% of a corporation. There's also a policy that we have that we don't invest directly into specific companies. You know, that was a decision made by the council in the wake of the pay-to-play scandal in 2010. And if we lift that policy for this company, it could potentially be a slippery slope of, well, if you did it for that company, why not this other company? Why not this other one? That policy was enacted as a way to try to create a barrier so that there couldn't even be accusations of appearance of pay to play by investing in companies while we have elected officials and especially governor on our council. But beyond that, there are some serious concerns about the trade-offs that would occur if we were to purchase PNM. By buying PNM, because we have no other utility operations in-house, we would be able to offer no economies of scale. And so we would be able to achieve no greater efficiencies than PNM achieves today. We already have New Mexicans complaining about the rate hikes that are occurring under PNM today. We wouldn't be able to do anything about that unless we lowered rates at the expense of our returns. One common misconception is that we hear is if you're targeting a 7% return and if the PNM profits are a little bit over that, why can't you just do that? And it's an issue of people not understanding our diversified portfolio, where because we have quite a bit of money in bonds and other assets that are intended to offset the volatility of, say, the stock market, it means that the other things that we invest in have to produce much greater returns than 7%. And so if we were to purchase P&M and earn a 10% return, that would be at the expense of higher performing assets and would draw down our total return targets. And so really, it unfortunately would create a situation pitting the ratepayers of New Mexico against the beneficiaries of our funds, including it to a large extent, children in the K through 12 system.
Any additional questions?
Mr. Chairman, thank you. That was a lot. But I think for me, it was more about the risk, the concentration risk. And a lot of people don't know or understand. They just see we have 75 billion and they assume that we can just help. And that's not what this council or what our fiduciary responsibility is. I do agree that maybe we could have worded some things a little bit differently, you know, not pitting education against something else. But I think we as the council gave him the directive to educate people. And there was also a misconception that somehow maybe John had overstepped and somehow maybe the legislature oversees the State Investment Council. And so I just wanted to make it clear now that I have my own pulpit, that John works for the SIC. The SIC hires John, and then we give directive to John during these meetings, and then he has to go and like make it work, right? The other thing I wanted to make clear, I guess, because something's in my coffee and I got spicy all of a sudden, is our private equity asset allocation is about 20%, correct? 15? And so, and it's been at least 15 for like ever. And I'm so sick and tired of elected officials, not including myself, saying that we don't like private equity, because I want to be clear that private equity being in our asset allocation has helped us get to second in being the largest sovereign wealth fund. And so that frustrates me. And then you're going to love me even more because I'm also frustrated. It's campaign season. So I hear just a lot of stuff and it drives me nuts. When people say they don't like oil and gas, and oil and gas contributes how much to our sovereign wealth fund?
Mr. Chair and Madam Treasurer, nearly everything. Almost all of our inflows that come from something other than our returns come from oil and gas.
Okay, so thank you. So, I mean, there's parameters, there's responsibilities with everything that we do, but at the end of the day, the reason why we have the money we have is because we have a partnership with oil and gas. And when someone says they don't like oil and gas, what they're telling me is they don't like us funding our schools, because that's mostly what we've used it for. And so I just want to be very cautious that we're very clear where we're getting our food at our table at and from, and it has a lot to do with private equity and it has a lot to do with oil and gas. And so I just wanted to make sure it's clear to those that don't understand it, that are listening, that this is really important to understand, like, don't bite the hand that feeds you. Thank you, Chairman.
Thank you very much. Any additional questions, comments? Okay, hearing none, we will turn to item 2B, our CIO report. Ms. Varela.
Members of the council, thank you so much. It's an honor to be in front of you for the second time. I will try to make my comments as brief as possible because we do have follow-up presentations from our consultants on the macro environment, market environments in general, as well as fund performance. But I did want to introduce a new concept to the council, which is our monthly CIO update. So what this is an attempt to do is just have a regular cadence of communication between our investment team and the actions that we're taking, as well as any sort of updates as we go to council. So if we turn to page 9 of our presentation, first is just a quick macro overview of the first half of the year. I'm going to just hit very, very high points because our RVK partners will be much more in depth as they are next or coming up on the agenda. But first, growth remains resilient, but we are starting to see broadening in the asset class. So we are seeing broadening beyond AI, and tech continues to be a strong investment, but we are actually seeing that there's less of a reliance on one single sector now. So that's really positive for the diversification of our portfolio. Labor remains strong, but does continue to slow. We still see unemployment at a pretty low rate, and we're now looking to see increase in productivity. But overall, labor is supporting, or healthy job market supporting, strong consumers as well as a strong economic picture. And then last is inflation. It continues to be higher, and we are seeing higher for longer. That does create some pressure for some of our risk assets like equity, but also, reminder, improves some income potential for our debt, both public and private positions, as well as our real assets or inflation-sensitive assets. So when we're looking at what our investable markets look like thus far, equities remain expensive but broadening, so we're encouraged by that. Fixed income and credit, we're seeing higher income because of those higher interest rates. And private markets and alternatives continue to be a place to add diversification and tap into unique themes like AI and energy transition, themes that we are seeing provide tremendous value for the portfolio. So although slightly underperforming public markets for the shorter term period, we are seeing that there's still a tremendous amount of value in alternative investments going forward. Are there any questions on the macro environment or our investable markets? Great. I will move on to just a quick snapshot of what our fund looks like. So as of June 30th, we hit $74.9 billion. And more importantly, for the fiscal year to date, the fund is closing out performance at 12.92, a very nice, strong return for the portfolio, primarily led by our public equity results. So our contributors, if you look, we had our US equities with really strong absolute returns, over 23%, and tracking its benchmark nicely. We see public fixed income markets outperforming its benchmark and hitting close to 5%. And then real assets continues to be a strong positive contributor to the portfolio, returning 13.4% and outpacing CPI with the premium by about 6%. So very strong value contribution for the portfolio. And when you look at detractors, we also want to highlight those as well. We see our non-US equities still very strong in absolute return at almost a 24%, but underperforming that ACWI benchmark by 2.6%. We are watching that. No immediate portfolio changes are being considered, but we are monitoring the underperformance and believe that that will continue to normalize. Real estate hit a 2.55% for the fiscal year and underperformed its private market benchmark with a premium by 1.3%. Also watching this area, real estate's been a challenged area for a while as valuations have been depressed and transactions have been depressed. And then national private equity with a strong return of almost 10%, but underperforming its private market benchmark by 1.7%. As you all know, we're continuing to ramp up our venture exposure in our national private equity program, and we expect to see a bit of a lag against our private market exposure. So I think overall, what I would note, and I did put this in the bottom here, is specifically for real estate and national private equity, those private market short-term results will look a little different. If you look at the longer-term results, we do see that these two portfolios track their benchmarks nicely and have contributed to overall value of the fund. Are there any questions on the portfolio? All right, we will move on to portfolio activity. So as you all likely know, it's been a busy almost 3 months for us at SIC and the investment team and I getting acclimated with each other. Spent a lot of time with our team doing total portfolio reviews. And the entire goal is to determine whether or not there's manager overlap in the portfolio, manager concentrations, or any sort of portfolio misfits that need to be identified and managed. And from that, for the last month, we have 2 activities that we reported to our investment committee. The first being a $225 million partial redemption from Harvest. This is not performance related. It's actually the opposite. Harvest has had an over 20% calendar year to date return, and we're actually just realizing some gains. So this is a highly volatile asset class, And it made sense to take some of the chips off the table, if you will. For that, we use those proceeds to fund our monthly SIC cash needs. So no additional investments that needed to be brought to council and no additional next steps there. And then lastly is closer to portfolio misfit. So we did a $300 million partial redemption out of the Garda Fixed Income Relative Value Fund. For this, there is a strategy misfit. This is a fixed income relative value hedge fund that was sitting in our private debt portfolio. The opportunity to deploy that into private markets is a strong one, and we did evaluate that and make sure that we also looked at manager concentrations. So this was one of the larger positions in our private debt portfolio. And between the misfit as well as the manager concentration proposition, we determined that we were going to bring this down. So this is a partial redemption of $300 million. We will have liquidity terms on that, so we will see quarterly payments come through. For this, we do plan to reinvest these proceeds into private markets, and we'll bring those recommendations to the council for approval. Next steps here will be to finish up and have a full redemption of this position so that we can deploy into similar risk assets in the private debt portfolio. Are there any questions on our activity? All right. And now what I'm most excited about and what I rambled on about in the very first meeting that I had with you all back in August was the vision for our governance roadmap. And I promised that I would bring a roadmap to the table. We will formalize this in our annual investment plan, but on slide 13, you can see the work that we're planning on doing together. I plan on having one-on-ones with everyone now that we're out of the end of fiscal year to make sure that this aligns with our council's goals and objectives. But as you can see, we'll start with asset allocation. We're in that regular cadence for review, and we're really excited to get this going. The first step will be after this meeting today, we'll begin with the sentiment survey of council. So we'll send each of you through RVK, we'll send each of you a survey, just really testing or understanding your thoughts on our risk, our manager selection process, portfolio challenges. It's just about everything you could think of. What we're trying to do is tease out key themes that will help guide our asset allocation, education, and conversations to come. So that will go out to you today. And we're asking that that be returned to us by September 1st, so we can then move forward with education through September, October, and November. And we are planning for action here. As you can see, we'll have a multi-educational component, so we can talk about risks, we can educate on why asset allocation is important, we can bring modeling to the table for consideration, and we'll have eventual adoption in January. And then we go on to the next key governing tool, which is benchmarking. So within our strategic direction, we'll focus on asset allocation, formalizing benchmarking, and having a council philosophy on benchmarking. Same thing with liquidity, formalizing liquidity and having a council philosophy on liquidity. And then we will look at our investment policy statement to ensure that we are utilizing best practices there and that we're really solidifying what the council's goals and objectives are. This will also include responsible investing provisions, just so everyone knows. And then we'll be doing some work on the staff side. So you'll see strategic oversight. Oversight of implementation is another critical duty of this council, and our staff will be doing some work and presenting either action items or education to you all. First is external client administration, which we're actually going to start the conversations today about. So that's a little bit later in our agenda. We'll look at a formalized investment committee work plan, so our committee knows what the key milestones are year over year. The team will be looking to formalize manager selection and monitoring. So we'll take some internal time over the next quarter to formalize that process and implement it within our team. And then we will bring that to council and to investment committee for education and for feedback. And then we'll be looking at our total fund reporting and our alternative asset reporting, making sure that it's transparent, digestible, it hits each of the goals and really identifies whether or not we are meeting the expectations of council over time. So we do have a very busy year ahead of us. I'm really excited about the work that we'll do together. Do I have any questions on the roadmap? No. All right. And the last update is on our staffing. So I think John did a great job. I won't spend too much time here other than to let you know that we are actively staffing our investment team. So as you know, the investment team of 12 and 13, including me, is not enough for management of 75 billion. We are currently in active recruitment looking for portfolio managers and analysts in private equity, real estate, and private debt. And we just went live on the portfolio manager for private debt, which is why it's not on here. So I apologize. And just a little bit of color on systemic risk, especially because we talked about oil and gas and its importance in the portfolio. Systemic risk for us is a total portfolio function. We have shifted Bruce into that role for us. And really what it is recognizing that we have a concentration on conventional energy, and our inflows are very reliant on conventional energy and the energy transition picture. That is a positive thing for our inflows, but can be a significant risk in the portfolio. So what Bruce will be tasked with doing is evaluating our sensitivities, understanding if there's any areas that we need to kind of diversify our risk exposure, and essentially help the CIO understand the non-financial risks within our portfolio. This is a new position and we're building it out together, but we're very excited about it. And I think it just really helps us think about our portfolio more holistically. With that, I will stop and answer any questions that the council may have.
Thank you. Any questions on our CIO report? Okay, hearing none. Thank you very much. We will turn to item 2C, our Chief of Staff and Business Operations report.
Mr. Chair and members of the council, thank you for the opportunity to present. As Santiago Treviso comes up to the table, I would like to take the opportunity to thank Talon Watchman. She was our intern with the Girls Who Invest program. She showed up eager to learn, produced exceptional work, and brought a joyful presence to the office. We wish her the very best moving forward and have no doubts that she will excel in any and every path she chooses. Her internship ended on August 14th, so unfortunately you didn't get to meet her, but she was an excellent addition to our team. And now I will introduce Santiago Treviso. He is with the Investment Talent Development Collaborative, IDAC, an organization dedicated to expanding access to careers in investment management and finance for talented students. And he is a homegrown New Mexican, so we were very excited to have him on board. Santiago, go ahead.
Hello, everyone. It's great to meet everyone in the council. And yeah, as Helen was saying, I got to be a part of the State Investment Council this summer, specifically on the debt markets team with Tom and Ryan with IDAC. And it was a really great opportunity for me to be able to, number one, like learn about the investing world. Number two, be able to get a lot of exposure with a lot of the managers and really be able to learn about the industry, as well as learn about all the different asset classes and all the different types of ways you can kind of enter the field and grow as a professional. I think it was a great opportunity for me being able to graduate here from Cleveland High School, 50 minutes away, to being able to graduate as well from New Mexico State University, where I was able to do a degree in economics and applied math. And for me, I'm very excited and passionate about the investing world, and I'm looking forward to seeing what's next. And I'm very grateful for the State Investment Council for giving me this great opportunity to be able to learn and be able to learn as much as I can with the team and explore all the different asset classes. So I'm looking forward to what's next.
Thank you very much for being here and for helping out over the summer. It's a wonderful program.
Thank you.
Any additional comments on the report,
Yes.
No, sir.
Oh,
Madam Treasurer?
Santiago, how did you learn about SIC? Tell us about your little journey before you got to SIC.
Yeah. So I originally learned SIC through a trip that I was able to do with my student organization, the Financial Management Association, where I was able to attend, go to the office. I think it was back in November of last year, and I was able to meet with Tom and Tom and Ryan, where they basically gave us an office tour and they taught us about fixed income and private debt. And for me, that was for me the first exposure that I had to the SIC. And then from then on, I was able to go to the Treasurers Conference was it late March or April at UNM, and then from there, I was able to connect with more members from the SIC. And then while I was in Boston doing another internship that I was doing earlier this summer, I got a call from Kevin, who said that it would be a great opportunity for me to be able to intern with the State Investment Council. And for me, it was a great opportunity and one that I definitely couldn't turn down. So I think that, yeah, and from there is really where I was able to get my first experience with the State Investment Council.
And Mr. Chairman Santiago, what did NMSU classes do for you to help you be prepared for this, or what could they have done differently to help you to prepare?
I think NMSU classes prepared me very well for the work here at the SIC. I think doing a degree in economics and applied math, it really showed me kind of how to think about lots of like arbitrary problems that you might have, or because a lot of the work that people do at the SIC, it's not necessarily like very straightforward. It requires a lot of thinking. And I think being able to take those math classes I was able to take, be able to take the finance classes, the accounting classes, the economics classes really showed me to how learn how to think and be able to solve problems and kind of looking at it from a different perspective. In a sense, I would say that I was very well prepared due to
Awesome.
education from New Mexico State.
Thank you. I'll yield to Nick for a moment.
Okay,
Mr.
Madam
Chair,
Clerk.
great to have you here, Santiago. I wanted to ask John Clark, is this the first cohort that we've had with interns?
Yes, Mr. Chair, Member Tays, these are our first ever interns this year.
Okay, great. This is really a nice thing to see and a great thing to have as a part of the SIC. I think it's really important that we try to focus on New Mexico and look at, students that are highly qualified to, create that pipeline to work for the SIC. I think that's something really awesome to see because I had not, experienced this before, and hopefully we can continue that work to generate that pipeline because in finance a lot of times it's just the kind of nature of the work that our local students leave the state for that work, and so we need to keep them here and hopefully you won't leave the state, but if you do, you'll come back at some point and help us out here in New Mexico. I did want to ask you, Santiago, what was the most interesting thing that you came across during your internship with the SIC in terms of like the portfolio and things like that?
I would say two things. Like number one, I think for me it was very interesting to be able to sit in on a lot of the conversations that the asset class directors are able to have with the managers, and I think it's a very interesting dynamic, and it was something that I was able to learn a lot from about kind of like how people talk professionally, how the market works, what people think about the market, how different opinions kind of challenge each other in these meetings, and people are able to kind of like talk in a way where you're able to learn a lot about the market. I would say as well, another very interesting part was a project that I was given by Tom and Ryan, where I was able to look at all the different pension plans around the country and the different sovereign wealth funds around the country. And I was able to look at their credit allocations and looking at their private debt allocations and their public credit allocations. And I think it was very interesting to kind of see where we stand compared to everyone else and how, for me, it was very interesting just to see kind of like how everyone invests and how every pension plan can be so different, or how some might share some similarities with each other. So I would say for me, that was the most interesting thing.
Wonderful. Thank you, Mr. Chair.
Thank
Mr.
you,
Chairman.
Madam Treasurer.
I could explode right now, and I know you guys could feel it. I feel like my heart just wants to like beam out because I love this program, but I love the impact that happened because I had the Girls Who Invest. I took Annabelle from the Cultivating a New Wave. She's my admin assistant. She just got her master's degree. Santiago was there. He got to meet John, Ryan. Then he had already known Tom. Tom's like a big Theo for you. I know it. I could just feel it. And I feel like a big Theo. I'm so proud of you. This is exactly what we need to be doing for our young people. Oh, I can't believe I'm crying. I'm mad at you. But I will say this to all of you. This is why we do it. Like, yes, we do rate of return. Yes, we do all this other stuff. But to have our young people excited about what Tom does, that's not necessary. That's exciting and that's motivating and that's energizing for our young people to want to stay in New Mexico and see a reflection of themselves in who they got to be surrounded by is super amazing. And this is exactly, I didn't even know this is the benefits. Like I did it because I felt like we need to do something because out-migration is so high. I'm hearing stories from the young people when I go to NMSU and UNM that they've applied for 100 jobs. They got maybe 10 callbacks and they only got 3 interviews. If you don't believe me, ask Annabelle. This is a critical program that we did, and I know it takes a lot of time and I know it takes a lot of energy, but at the same time, I think the staff, this is what happened at my office. The staff actually fed into it and they became their better version of themselves. They became more motivated, more energized, more excited. I met Talon. Talon's amazing. Talon went with us to one of the pension fund retreats in Taos, and I had all 4 girls, because I'm cheap, all 4 girls sleep in the same room. It's okay because they built relationships that they would have not had. What I also learned from that is some of our students from NMSU and UNM versus the girls who invest, who was mostly Ivy League, they had a disparity in what they had learned, in what doors were opened, in what access they had. And so the 2 groups of girls being able to communicate with one another allowed them to realize that there are other rooms and buildings and doors and windows that they can go into that they didn't even know existed. And so I am very firm on loving this program and us keeping it up, because I think it helped our teams as much as it helped our young people to hopefully see that a career in service and in government is just as great as all those guys on the other side of this that do their part in this. So whatever decision you guys decide to make, I want you to go back to NMSU and I want you to brag about your experience. I want you to tell Dr. Hari, because really Dr. Hari was the main focal point of making me do something like this. Leanne Laraniaga, who used to work at Para, I still owe her a call, so please tell her thank you for me. She was the one who kept pushing me to do a Girls Who Invest because I have all women as my portfolio managers and being the first female treasurer. She really pushed this. And so it was like, ugh. But then now it's like, it just feels really good. So I know I took a lot of time, but I want to thank you. You did a great presentation. Thank you to all the SIC staff for leaning in and pouring into our young people that you got to interact with. And Tom, I know that that passion is in you like all the time, and I love it. And I thank you because it motivates me too. So thank you, Mr. Chairman.
Thank you
Mr.
very
Chair.
much. Yep.
Oh, I would like to add that we have 5 out of 7 members of the senior management team were born in New Mexico, educated in New Mexico, and graduated from New Mexico schools. And 6 out of 7 people on the senior leadership team attended universities in New Mexico. So this program is also very important to us as being products of New Mexico education.
All right. Thank you so much for your presentation.
Thank you.
Excellent job. Okay, I believe we are now on 2D, our performance report with our CIO and RVK.
Chair and members of the council, thank you so much. That is a tough one to follow. I don't know if our performance is going to bring the crowd to applause and tears, but I do know that I'm very proud of the results that we have. I will hand it over to our RVK consultants to review our fiscal year-end results.
Great. Thank you, Mr. Chair. Good morning, everyone. It's good to be here. We do have your executive summary for the fiscal year.
Maybe speak up just a little bit there.
Thank you, Mr. Chair. Is that better?
I think so, yeah.
Okay. Try to project more.
Okay, yeah.
Yes, we do have your fiscal year-end executive summary in front of you in your packet. We'll talk about that in some detail. Kristen's already provided you with a high-level overview of the macro environment. We'll build on that and try to tie it into what you'll see in the performance figures, of course, as well. It has been a very good year for the fiscal year, as you'll see, and a lot has happened. And so we'll talk about that as well as more recent events, which I know are of interest as well, given all that's happened since the close of the fiscal year and into the new fiscal year here that started about 6 or 7 weeks into it. If we can turn to page 25, I believe that's the updated page number in the packet. Yes, you'll see that we have your market performance on the bottom left here. And overall, you'll notice that risk assets, predominantly public equities, but really all risk assets, rallied in the second quarter and really for much of the fiscal year, although it wasn't a smooth ride, as you might remember. First quarter, pretty tough, volatile at the onset of the U.S.-Iran war, and that, of course, had major implications in terms of oil prices and market volatility. In fact, WTI shot up to about 120. There was worries that it might go up to 150, and that has since come back down, at least through the end of the fiscal year, into the 70s, and that was a big driver of some of the returns that you see for the quarter, and that's the QTD column, that first column, followed by calendar year to date, and then the 1 year, that's actually your fiscal year, so that would be 1 year ended June 30th. And you can see that even though we had a tough close to the end of the first quarter, actually the second quarter, based on some de-escalation in that conflict, as well as fairly strong continued investment in the AI, we saw very good returns that actually offset all of what has happened. And so you can see S&P 500, for example, up 15% in that quarter and brought the calendar year to date up to 10. So it was negative, and then it turned positive. But probably more interestingly is really what happened over that 1 year period. And you're seeing some very, very significant returns across particularly the public equity asset classes that has some tie into private equity that we'll talk about, just a very difficult benchmark, considering how strong the public markets have been. In particular, small cap and emerging markets would be areas we point out, 40% in any 1 year. Anyone who's been through our capital market setting process knows that 40% is not what we expect in any given year. That's a substantial multiple of that, and tends to have implication on forward returns. But you might also recall that small cap and emerging markets were some of the areas that had lower starting valuations, so they had more room to run. And so it's not surprising that the S&P 500, for example, which has been dominated by the Mag 7, is sort of easing up. It's not hitting the brakes, but certainly easing up on the gas pedal in that type of environment. And a lot of that has continued into the start of this new fiscal year. We're also starting to see a bit of a rotation, again, out of growth, more into value. And when you're looking at what's working, it is a bit of a shift. You'll recall that all of these things, whether it's U.S. versus international, large versus small, value versus growth, they all go in cycles. And we have lots of charts to sort of depict that. And this is just a natural evolution of that. Too early to tell if there's a turn there, but certainly value versus growth, that differential is about as wide as it's been. So wouldn't be surprising, as well as where we are in the business cycle, that value is getting some attention. I think one of the key connecting themes that we've talked about is fairly strong inflation, certainly inflation above Fed target rates, which is about 2%. June ended at 3.5%. That's only backed up a little bit in July, 3.4%, and so it's substantially higher than where the Fed would like it and where it's been. In fact, it's the highest level it's been in 3 years. And so when you're coming out of the pandemic and we saw massive numbers getting close to 10%, maybe 3.5% doesn't feel like a lot, but it's still quite a bit higher than it has been for some time. And we also came out of the GFC with basically no inflation for over a decade. So this is all very new in some ways, new in terms of near-term history, but not really new in terms of zooming out. If you back out 30, 40, 50 years, then it's like, okay, this actually doesn't feel all that different. It's just different from what we're used to or what we've been trained to over the last 20 years, which has been kind of a one-way street and one-way trade. So that inflation continues to be a bit of a concern. We obviously have a new Fed chair. We're starting to see a bit of a more hawkish tone, just a recognition that despite their dual mandate of full employment and managing inflation, perhaps inflation, at least at present, is the higher concern. And so while we started the year with expectations actually of rates coming down on the short end anyway, the Fed fund rate, now expectations are actually for increases. I think for the next meeting, it's somewhere around 69% of a 25% or 25 basis point increase. And then October and December are actually much higher than that and could even see up to 50 basis points. Those are current probabilities based on where those are being traded at. But it's to show that there's upward pressure on those Fed fund rates. That I think is an important macro shift and certainly very different from where we started out the year. Again, when you do have excess liquidity, we talked about real rates being important, not just rates, but also inflation and the real rate that is actually earned. That's an important consideration when you do have excess. I won't call it idle cash, but excess liquidity that continues to come in that staff has been thoughtfully deploying. When you have positive real yield, of course, you can be a little bit more patient. When you have no real yield or even negative real yield, that starts to be a real opportunity cost. So that's why we always want to look at that and make sure we have a good understanding and it factors into it. But big macro shift in terms of where we started out the year. Probably also of interest, and even though it's not a magic number, but we did, of course, see the federal debt cross the $40 trillion threshold, which is pretty amazing. And in fact, it was just half of that 10 years ago. So it's been on a sort of hockey stick incline, and that's something that I think is not immediately a problem, but certainly indicative of a lot of the things that we're seeing, including rates on the longer end going up and just some concern about the fiscal sustainability and general prudence of those debt levels. In fact, the interest rate payments on the existing debt are over $1 trillion, and that's the third largest line item in the budget. And in fact, it's tied with Medicare. Only Social Security is higher, and so those numbers are expected to change, and especially as that debt has to be refinanced at higher rates, that could continue to increase. And so there are certainly worries that at some point we've got to pay the piper and pay for some of those sins of the past. And when interest rates are low and you essentially can get away with amassing a very large debt on the balance sheet, that's one thing. But when interest rates change, it goes very quickly. And so that's why you're seeing gold, Bitcoin, there is just volatility in lots of different other areas where folks are saying, I'm not so sure if this is the place I necessarily want to be. Let's see if I can get some diversification there. That's why you're seeing some volatility in the dollar, in rates, in lots of different parts of the market. And I think it's a good indication that the market is recognizing we're not on a terribly sustainable path at current. You probably also saw Treasury come out and say we're going to repurchase or purchase bonds and try to drive down yields. It's a little bit of a Band-Aid, and like any Band-Aid, it's a short-lived solution that worked for about a day or two, and then rates kind of went back up. Again, I think it's the markets and the bond vigilantes sending a message that, look, we're not on a great path right now. And the only way to do that is to curtail spending, of course, to try and get that under control. Just like anyone else, you got to make sure that money coming in and money going out makes sense. You can't just spend indiscriminately. So that's something that I think is noteworthy. Of course, there's two sides to that. As someone who's looking to get credit, when interest rates go up, that can be problematic because you're paying for more. That kind of works its way through certain parts of the portfolio. But on the lending side of things, you actually get more. You actually get higher interest payments. So it can be an opportunity to restructure the portfolio in a way that actually takes some risk off the table and still provides reasonable rates of return. So it's not all doom and gloom. It's just, I think, a recognition of what's going on in the markets and being nimble and thoughtful and proactive to take advantage of whatever the market is giving us. So we talked a little bit about commodities, and that's the one red number on that bottom left-hand table that you saw. That's a byproduct of just the energy sell-off. A lot of that has since reversed. We're back at 85, I think, from 70. And in fact, quarter to date, so for these first 7 or 8 weeks in the third quarter, commodities are up actually 14%. So a lot of that, we're just seeing a ton of volatility. Don't read into the short-term numbers too much. But I think a good testament to just having a diversified portfolio. We talked about the oil and gas being a tremendous resource and contributor to the inflows. So it's good to have diversification and just a recognition of where the markets stand. So I know that was probably more detailed than maybe you hoped for, but I think there's a lot happening, and yeah, we didn't want to sort of gloss over anything. So I'll stop there. I think we'll go through the fund performance and then we'll take questions.
Thank you, Chairman Bingaman. And I just want to say to the treasurer, I got choked up too. So we've always had an active intern program at RVK, and last year I was asked to direct our internal RVK Academy, and we just started our second year term. So it's been an honor, and I would say that we've been successful in keeping employees. 50% of our consultants started at RVK as analysts. Our CEO started at RVK as an analyst. So, and one of our management started as an intern. So we believe in growing our own and keeping them home. So with that, let's go to page 26. And we will show this in all quarterly reports. You've created 7 asset allocations to meet the objectives of the individual funds that you manage. And we have grouped them there to keep these in front of you to show you those allocations and to see from most aggressive to more liquid, just this matrix. I think it's helpful to keep in front of you, and maybe it'll even come up later today in a discussion on the external funds. With that, going to page 27, looking at asset allocation versus a policy index. Just a reminder, this first page is the 3 largest funds. 88% of the assets that you manage are shown on this page. These also are the funds that have interim allocations. It takes a while to deploy capital into private assets. You will see that you are overweight even to your interim target to fixed income. And if we compare that to your long-term target, you're very much overweighted to fixed income. And when we look at ranks, knowing that you have also less public equity than many of your funds, as Matthias said, it's been a time that public equity has been quite strong. You have more fixed income than your goal is to have, but just knowing that you can't get that invested in alternatives so quickly. I just want to point that out. And I think if you go to the next pages, you're very close to your target. Your staff has been keeping you rebalanced, moving you closer and closer to target, and obviously meeting managers and getting those assets committed is very important to get you to your target. If we move to page 32, you can see the fund, the performance for each of the funds. You know, like quarterly and 1-year performance is relevant. Your objectives are long-term, so looking over towards the right-hand side of the page or the middle of the page is really where you want to notice that performance. You will see that you have been close to your policy benchmarks, knowing again that you'll see some underperformance, but remember, you're not even at your interim target. You're overweight to fixed income. Some of those things we understand, but just on an absolute basis, look at those numbers. They're incredible. 3-year return for the land grant and these are all net of fees, of 10.65, 1 year at 13.12. and down the road, just really strong performance. And we have grouped these from the largest assets to the lowest level of assets. So again, land grant, severance tax, and early childhood are up at the top. But I would just say you will see some red underperformances, are mostly with the larger funds that are having a difficult time getting those assets deployed. The next page, going to page 34, this is our schedule of investable assets showing, and this is calendar year to date basis. So it's the beginning of 2006 to June. I think this is a very telling page. Total fund is at the top. This shows you contributions, it shows you distributions, it shows you gains, which is great to see. They're all black numbers, not red numbers. So just to point out for the total assets that you have under your management, on a calendar year basis, the assets increased by 5.3 billion just in those 6 months. If we go back to July 1st of 2025, that's an 11.2 billion increase in assets just in that 1 year period. Now, again, that's not just performance, that's contributions, but also is distributions too. You've had more contributions and distributions. I also want to point out that what is the 5th largest balance is your external clients. So your external clients was about 4.3% of total assets. And I did skip, I also wanted to point out for land grant, just to talk about the 1 year period since it's your fiscal year to date, just for the land grant for the fiscal year, assets increased by 5.3 billion. So significant growth, which you have seen on a monthly basis. Let's go now to page 36, and peer comparisons are useful context, but they don't match your objectives. So you always should evaluate versus what your objectives are and versus your policy stated benchmark. So this is good information, but it's not an objective. To get to the point that was made earlier, you'll notice that your ranks for the shorter time periods were well below median. The land grant ranked for the quarter 74th percentile. You're not used to seeing that, but if you go longer term, you'll see that you're at that place that we've talked about, being at or above median. If you're consistently at or above median, we think that's a good place to be. You're not historically it's getting, I would say, long historically, you used to be at the top or the bottom, but having that consistency. And for the 5 year period, you ranked in the 22nd percentile, the 10-year period right at median at the 47th percentile. So that, again, matching, knowing that's good information, but not true to what your true objectives are. I want also to cover page 38. This is the risk return. On the top, we're showing five years and 10 years on a risk return. The yellow triangle pointing down is the land grant policy, interim policy. Below that is actually the green diamond, which is actually the land grant. So what this is telling us, if you looked at the actual numbers, land grants return for that 5 year period net of fees was 7.24. The median was 6.64. So you had 109% of the median return, and you got there at far less volatility. Your standard deviation was only 75% of that of the median plan. So you're following in that northwest quadrant where you have above median return at below median risk. That all translates we're not going to go to that page, but I think it's, page 50 in the appendix, showing your consistent Sharpe ratio in the top quartile, which really indicates that you have your risk-adjusted return, your outcomes relative to your peers are quite strong. They consistently have been in the top quartile, really beginning with the 5 year rolling period that ended in 2016, September of 2016. So strong risk-adjusted returns. Page 39 looks at asset class performance. The three top are showing the three largest funds. But if we go down, you can see the U.S. equity. Your CIO spoke to this with U.S. equity showing outperformance for the 1-year period, some slight underperformance longer term. Non-U.S. equity has had a record of strong outperformance. It has been repositioned and has had some underperformance. Again, looking at the numbers that Mattia showed us, especially with emerging markets in the short term, you don't have any dedicated managers to emerging markets now. Public fixed income, strong outperformance across the board. We also saw cash. If we go to the next page, just a couple comments. We're not going to go through all the privates because I think you'll be receiving the reports from your specialty consultants next month. But I do want to point out a couple things on your private debt. Again, has been additive. Where would that money be? Perhaps if it wasn't in private debt, maybe in your public market fixed income. Public market fixed income 5-year return outperformed its benchmark wholeheartedly at 1.39%. The private debt allocation was up 6.47. So having that diversification and higher return potential, you've witnessed that. And lastly, on as far as returns, looking at real assets, just pointing out the strong returns in the real assets that you've experienced for the reasons that Matthias spoke to earlier. Other than that, like I said, your specialty managers will be talking to you next month, but I did want to show that this report now breaks out the national program, the strategic venture, always had the breakout of the ETIs, but now kind of that legacy New Mexico private. So now they're all bucketed together and you can see how they're doing.
Yep. CIO.
Yeah, Chair and members of the council, I think one of the largest takeaways here continues to be how we manage our cash flow, our cash inflows, right? So we are no longer holding cash in our portfolio, which is a wonderful thing, but we are overweight our high quality investment grade fixed income. That really reflects that slight underperformance and our peer rankings over the 1 and the 3-year periods. And it is one of the most immediate focuses for the team on the investment side. Next month, you'll see some recommendations come through from our team on expansion of our overlay strategy so we can get into more risk neutral portfolios. We're also going to start looking at strategic partnerships to deploy capital a bit faster. And in our asset allocation, we're also going to look at those private market targets, not because we don't have conviction in private markets, but we're going to look at it for feasibility and prudence, right? Can we actually get to those targets in a 3-year period, or do we need to consider what an alternative portfolio looks like for that time frame? So this is, when I look at this performance report, I like to give you takeaways, and one is strong absolute return that's exceeding our required return or our targeted return. But we are seeing a lag in our largest funds because of the cash inflows, and now solutions need to come to the table to help us get closer to that. And that's a focus for our team.
Makes a lot of sense. Are there additional comments, questions on the performance report from council members? Madam Treasurer.
Thank you. Thank you for sharing also, Ms. Marcia. Okay, so a couple things just on the nitty gritty, just because we have legislative hearings coming up and I want to make sure I understand what I'm reading. So page 3 or 26 in my packet, but it might be the CIC page, so I'm not sure. It's the summary matrix of NMSIC funds, like one of my favorite pages. The legislative appropriation provision, I understand the no on the bullet point for the little 5, but for the rural libraries, water trust fund, land grant, what does the no mean? Does that mean that and I think this is a Don question, but the legislature takes the money beforehand maybe? Because I know it's still legislative, but what do you mean when you say no to legislative appropriation provision column?
Sure, Madam Chair, members of the council. So For Water Trust Fund and rural libraries, again, also with land conservation, behavioral health, as well as severance tax. There is no provision in statute that allows for a direct appropriation from those funds, unlike the other funds, early childhood, higher ed, tobacco, and all the ones to the right side of that chart. There is specifically some kind of provision within statute that specifies very clearly the conditions upon which the legislature may appropriate from those funds. Most of them are in the event of a budget downturn and allow those funds to be allocated in that case, except for capital development and Medicaid trust fund. Those actually have direct appropriation provisions where they can be pulled from the corpus of the fund. Same thing with tax stabilization reserve.
Perfect. Got it. And then, Mr. Chairman, the target return to be determined, I thought we had a target return for every single one. We do not?
Madam Chair, members of the council, no, the council has only established formal targets for land and severance, and that is all.
Mr. Chairman, is there a reason why we haven't done a target return? And what would that reason be? Since Evan is nodding yes.
Madam Chair, members of the council, I'll also defer to anyone else who wants to chime in here, but my understanding is that because of the asset allocation studies that we engage in every year that sets what we think the expected compound return is based on the asset allocation studies, the council hasn't seen a need to develop a formal spending policy or spending target. I think it's come up once or twice in the past several years ago when we started getting some of these new funds and discussions on do we need to set formal targets for them. But I think that was then later decided that we would just monitor what those expected returns are based on the asset allocations and adjust accordingly, but happy to defer to anyone else.
I might just add that this conversation also brings up the topic of what the right rate of return is, whether it's an absolute number or whether it's a relative number. A lot of other funds, and probably rightfully so, actually use CPI plus a premium to say we want to achieve, which is more dynamic than having a 7% or 6.75%. So I think there's an opportunity to talk about what is the right framework, and then what number do we want to pick?
Okay, I think Evan has something he wants to do.
Less investing speak. We have a pretty good sense in land grant and severance of what the funds need and how we fund government and what the expectation are of the people who gave us those funds or put them in statute. When we have a brand new fund, there's an element of the folks who set up the fund and the folks who benefit from the fund to advise us or have conversations as to what their expectations are. And I think that's an ongoing process that we encourage and that we're engaged in.
Okay. So then, Mr. Chairman, on the expected compound return, how does that tie in to the TBD on the target return? Is there a connection?
Chair and members of the council, that expected compound return is going to come from our asset allocation process and the capital market assumptions that we have, and we'll review with you all with RVK alongside us for the asset allocation process. So one is showing you what we forecast in terms of the risk profile and what that return and that risk could look like, where the targeted rate of return is more of a mandate imposed to us through council. So we certainly can have that discussion. Unfortunately, I'm not we'll have to work together to understand the funding needs of these other TBDs because I'm fairly new and have not gotten there yet. But we certainly can explore whether or not those other mandates should have a targeted return profile.
And Mr. Chairman, I'm not asking, I just love to ask questions that I don't understand what's going on. I was expecting the 7% and the 6% up there, and I didn't see it there. So I thought, why are we TBD?
Yeah.
So I was trying to figure out the difference when I saw the returns on the bottom of the percentage on the compound, what the difference was between those two. So I think
Yeah.
you could take a look at it, but I'm not asking to do anything different. I just wanted to know
Perfect.
why or what the difference was on that. I want to go back to cash real quick because I know I always used to ask question about cash. Now cash isn't on there on that first slide. And now we moved it to somewhere else, probably to try to hide it from me so that I don't try to steal it, but not still, just use for baby bonds. But I wanted to know when you have your slide that we were just on and it says cash equivalent and it has dashes, but then when we go to the allocation versus the policy index and we have cash equivalent, why don't we have that number on that other slide?
Chair and Madam Treasurer, these are long-term targets. Our interim targets reflect cash positions so we can manage through that implementation drag. But long-term targets, we will not hold cash and cash equivalents as a policy.
So then my next question, Chairman, is how much of the increase is cash versus investment? And when we're looking at, let's say, for example, you're talking about the benchmarks. Are we including the cash in there or are we not including the cash in there? Because that could impact your benchmark. And so I want to make sure we're being thoughtful of that.
Yeah, Chair and Madam Treasurer, the interim policy target does include the cash allocation of, I believe, 5%. So that is factored into performance and the benchmark itself. And I think that that Marcia did a great job on slide 11 of the RVK presentation. She does show how much is actually contributed to net inflows versus gains and losses in the portfolio. So if you look at land grant, we did have inflows, as you can see, as well as distributions and contributions of 1.1 billion, and our gains are 2.3 billion. So we are showing the difference between cash contribution, increasing the value of the portfolio versus our investment gains.
So I do see that on page 34, but let me go back first to 27. That's my second favorite graphs. So the cash equivalents that we have there, is that what you're thinking of trying to figure out how to deploy quicker, something you mentioned in one of your goals?
Yeah, Chair and Madam Treasurer, our cash equivalents are actually quite small. That's really for operating, so I'm not concerned about that. I'm concerned about the strategic overweight that we have to core bonds in the portfolio. So prudent place will not experience a lot of volatility. We're getting reasonable yield. So it's not something we have to act on right now, but we are not in the risk markets that we as a council have agreed we should be in strategically over the long term. So we are significantly underweighting our growth assets in a market where you just saw growth assets have been double digits. That was a drag for our portfolio. We're underweighting our real assets, which also was a really strong contributor to the portfolio. And we're underweighting our debt, which is also a very, very strong contributor to the portfolio. So identifying opportunities to bring down that core bond overweight and put it into more risk neutral strategies is really the focus for the next 6 to 9 months for us.
Okay, and then Mr. Chairman, back to page 34, I did notice the contributions and distributions. Is that for the full fiscal year ending June 30th?
This is pages only calendar year.
So January to June. So I think for me, what would be really helpful as a council member is knowing the fiscal year, because we just ended the fiscal year. How much did we get in full contributions and then full distributions? I saw it says data shown as of 6/30, but I wasn't confident what time frame. I'm trying to tie in what those numbers look like versus the transfers that we do from my office that Arsenio sends out for many of the funds that you guys are in charge of, and the numbers weren't matching for me. So I think what would be good for the council, especially when you're saying, well, now we're 75 billion, and I was listening to the report this morning, it's like, mathematically that doesn't match. What's contributing? And then I was like, contributions.
Yeah.
And then the takeout for the new fiscal year is also a big one. So if everyone can go to page 34 on the council, I think this is important, at least for a snapshot of the 6 months, what this distribution looks like. But I know we transfer a lot in the end of December to SIC, and then again in June. And it would be helpful to know what that looks like, because that will help us understand not just the percentage of net return, but it'll look in perspective of contributions, what we're sending out, because that's just as much work. No one pays attention to that, but I do, Brent. And then
I was just asking him about that.
and then the rate of return based on like what we've actually made off of the money that we had. And then the other question I had, where did it go? That was it. Thank you, Mr. Chairman.
Chair and Madam Treasurer, we certainly can do that. So we have the cash flow data to show you calendar year to date. We can do that for fiscal year to date where we show contributions, distributions. So you see a picture of the flows for each fiscal year. I will let you know that the gains and losses or the rate of return, those are cash flow adjusted. So those already factor in the flows, the inflows and outflows of the return. So that gain and loss column or the percentage return, that is pretty, that reflects the returns of assets that we have in the ground offset for any cash flows, just so you know.
But Mr. Chairman, what that doesn't do is tell everyone else when they keep hearing now we went from 70 to 75, the math doesn't math that, oh my God, they can make $5 billion in 6 months. That doesn't make sense.
If only, yes,
So
I
that's
agree.
why it's important for us to know how much is coming into these funds from different places that the legislature puts forward, because that also helps us to understand the workflow, because rate of return and getting fund deployment of funds out is very different from the amount of work that happens on the finance side for inflows and outflows and activity within trades or within what Brent's office team does. And so I thought that would be really helpful for us to also keep in at the forefront of our conversations.
Okay, we'll take that as a follow-up item. Excellent.
Chair.
Okay, Member Tejas?
Real quick, Mr. Chair and Kristen, I was wondering, you had mentioned that we're overweight in fixed income. And, that's kind of the priority right now. What are you thinking, in terms of just a high level of, what are you thinking in terms of how we address that, moving, money from fixed income somewhere else? It's not just simply changing our allocation from, whatever it is now to like a 60-40, 70-40, public equity ratio of fixed income to public equity. Are you thinking of doing something different? Because the only reason why I ask is I think it's pretty well understood that the market is way overvalued right now in terms of U.S. Public equity. And so how do we fix that with that challenge in place?
Chair and Member Tejas, thank you so much for the question. Carefully is the first answer. So you're absolutely right that public market valuations are higher than they've ever been. Market concentrations are higher than they've ever been. That's not changing the fact that these companies continue to be profitable. So what we don't want to do is bet against corporate profitability as a broad theme. We will not be able to time markets. So what we'll want to do is ease into them carefully. When I'm thinking about what a more risk neutral portfolio looks like, it starts with a very simple recommendation to you all to evaluate our overlay program. So first, that overlay program can be a tool to utilize synthetic over-the-counter exposure that is daily liquid and can replicate benchmarks within our portfolio. Right now, we use that overlay just for simple cash management, and it replicates bonds, frankly. So we can expand that overlay program to assist us in taking that cash and bringing it closer to our benchmarks. And we've got a great provider to do that with us. So that's the first step. We'll look at in our largest plans, can we expand our overlay programs to get us to something that looks, the risk profile that looks a little bit closer to the benchmark. Next is we're talking to the teams. We will have to utilize public markets to help us get to a more risk neutral place. What I will tell you is over long periods of time, public versus private, you actually see correlations are pretty tight, and you actually see that the risk profiles are pretty similar. Volatility is the biggest challenge, right, in the mark-to-markets. We've got a lot of liquidity. We're managing our liquidity, and we're going to bring minimum liquidity requirements to council so we can consider that strategically, so we can actually absorb a little bit of that mark-to-market volatility. What that means is that our team is looking in places that they don't already have that optionality between public and private. They're looking for public market replication strategies. So our debt team is now starting to think about what a public market high yield benchmark strategy would look like. So we could overweight our debt a little bit. We've got our real assets team looking at a liquid infrastructure allocation that could look more inflation sensitive and infrastructure oriented. And then you likely see that we're maintaining our overweight to our public equities. So recognizing that our equity exposure and our growth exposure in our portfolios tremendously lower, we haven't been bringing down the slight overweight that we have in our US and non-US exposures. So I think it's a mix of strategic partnerships, expansion of our overlay, and just really thinking about what risk exposures we should be in and how closely we can get there. You are absolutely right that valuations are high. And entering into equity markets does feel like a challenge right now, but they continue to grow. And I don't know if I would bet against corporate profitability more broadly.
Thank you.
Thank
Yeah,
you.
there's really interesting research has been done too about some of the changes in markets and the rise of, the passive bid in terms of indexing and all the other things that could be just structurally driving valuations higher, that I think it'd be interesting to review that at some point.
Chair, I completely agree. I think one of the biggest focuses I have, yes, we are in a concentrated market. I don't think we talk about the passive contribution and how we have more nascent investors that are just rebalancing based on passive exposure and how that's also driving fundamentals in public equities.
Okay, thank you very much. Additional questions on the performance report? Anybody online? Okay, hearing none. Thank you very much. We will move on to section 3, portfolio recommendations and updates. I will provide the investment committee report. We did have an investment committee meeting last week. We reviewed the third-party client program update and IPS revisions. We did unanimously agree to recommend those revisions to the council for today's meeting. We also reviewed the voting items on the investment agenda today and unanimously agreed to recommend those to the council today. Any questions on my report? Okay, hearing none, we will turn to the National Private Equity Program and Bessemer Venture Partners Opportunities with Director Cassidy. And say hello to Mr. Feinstein. I think we have a mutual friend and hung out at his wedding 7 or 8 years ago. So nice to see you again.
Good morning, everyone. We're recommending 2 funds this morning. Bessemer Venture Partners is a firm you're probably familiar with. The SIC approved 2 commitments to other vehicles that they raise, one an early stage Indian venture fund and the other a middle market software growth buyout fund called Forge. We're recommending commitments of up to $75 million to their early stage platform, which is called Bessemer Venture Partners 13, and their growth stage fund, which is called Bessemer Century Fund 3. As kind of, I'm going to talk about portfolio fit and just the overall kind of strategy for the venture capital program as kind of review before handing it off to Richard. As a reminder, the SIC in aggregate between the National Private Equity Program and the Strategic Program has a roughly 5% allocation to venture capital program that we've been building really since 2020. The SIC had been out of the market of the venture capital asset class for really over 20 years. And so the way that we've been adjudicating that allocation, on the strategic venture capital side, as you know, we target managers that invest in areas where New Mexico has strength, which is things like, deep tech and quantum, climate tech and advanced energy, and things like aerospace and defense, as well as health technology and care delivery. And then on the national side, it's kind of everything else, which nowadays largely means artificial intelligence and biotech, but also some strategies outside the US like Bessemer's India Fund. We've targeted 20 to 30 managers in the strategic program, and then the national program 15 to 25. So Bessemer would be a new relationship on the national side, given their focus more on artificial intelligence. And while they do look at sectors that relate to New Mexico, their main focus is on artificial intelligence at this point, which they'll talk about. We're not discussing performance this month, but kind of how's it going? It's pretty hard to start a venture capital program from scratch. The reason it's hard is there's persistence in the asset class. All the best managers have access to the best founders and companies. Everybody knows that, including us, and we all try to give the same people money, including Bessemer. So we're off to a good start. I think it's some combination of picking good managers, but it's also it's been a good vintage to start. We started in 2020 in our national program. Through Q1, the venture capital sleeves, a 23% net IRR. And then in the strategic program, which really started at the end of 2022 with the Roadrunner commitment and the change in strategy officially, is a 33% IRR through Q1. So off to a good start. That'll actually grow venture capitals. And if you're in good managers that have access to the best companies, it's a very bullish period for venture capital. Now, not everybody's benefiting from that. You have to have access to those best companies, but thankfully our managers have punched above their weight. And then on the company announcement side, there's I think John probably mentioned it. I may have been out of the room. Today, Pacific Fusion is announcing their groundbreaking at Mesa del Sol in Albuquerque to build $1 billion research and manufacturing campus. And last week, a company called Castilian, which you may recall, announced $1 billion round. A big chunk of that will be going back into New Mexico to help support a 1,000-acre manufacturing campus in Rio Rancho. And so this is kind of the double bottom line of how we approach the venture capital ecosystem, partnering with the best firms in Silicon Valley, asking them to consider New Mexico when their companies are looking to build, and having site selection processes. And giving New Mexico a shot to win those when it's possible. And, shout out to economic development. They're doing a really good job they're kind of the closers in all this. Our program effectively provides the pipeline, but we need our economic development and our policymakers to, get these companies actually make the decision to say yes. Richard, I'll pass it to you to talk about Bessemer.
Thank you, Chris. Thank you, Mr. Chair. Like Chris said, Bessemer is an existing relationship in the program. The first commitment was made to Bessemer India, second commitment to Bessemer Forge 2, which is essentially a technology buyout focused fund. The two funds that we're reviewing today are the first time we're investing in these funds. Bessemer is one of the more established venture capital firms in the industry. The firm has a strong reputation, and that's important in venture capital because as Chris mentioned, you're competing to get into the best deals. You're competing to have relationships with the strong managers who are forming new companies, and so you really want to have that strong reputation, and part of that comes from your track record. The funds target technology investments in the areas of AI, cybersecurity, fintech, healthcare tech, and deep tech, which are all areas that are seeing a lot of growth right now within venture capital. Bessemer has a global platform with offices really across the globe, not just the US, but Europe and Asia also. When you think of the funds themselves, Bessemer 13 or the flagship fund really focuses mostly on early stage investments, but will continue to support companies through a multi-stage approach, while Bessemer Century 3 focuses on later stage growth companies, both companies that are existing Bessemer companies and also new companies that Bessemer had not invested in before. I think one of the things you'll see with Bessemer is their longevity is really shown in their team. The investing partners average about 16 years of tenure with the firm. And they really emphasize internal development as well. 13 of the 16 investing partners on the early stage side began as analysts or associates at the firm. Century 3 does have a separate growth team led by four senior partners who oversee all of the growth investments, but there's shared resources across the firm where they really help each other on sector research, sourcing, utilizing networks for adding value to portfolio companies. And you really see that from a strategy standpoint too. Bessemer has a strong sourcing platform to see a lot of opportunities. One thing they do is they develop roadmaps to actually identify companies that they should track within those attractive growth areas. But they've also started utilizing AI tools to identify emerging companies, which has really increased the deal flow that they see. In addition to the investment team, the firm has developed an operating and advisor network to support for portfolio companies, and this can include areas such as recruiting other management team members, business development, introducing to new customers, and also helping those companies raise more funds. Bessemer has a largely above median track record with many funds with metrics in the top quartile. When you look at their track record too, they've been exposed to some of the more recognizable names that have come out from venture capital companies like LinkedIn, Yelp, Pinterest, Waymo, and most recently Anthropic. And so we're recommending a $75 million commitment to Bessemer Venture Partners 13 and a $75 million commitment to Bessemer Venture Partners Century Fund 3. And I'll turn it over to the Bessemer team.
I'll kick off. Thank you so much. I mean, Richard and Chris did such a good job. I don't even know if we even need to present, but thank you all for the time. Thanks for letting us listen in. It's been great. I'm Anita Umarji. I head investor relations at Bessemer, and I'm joined by Brian Feinstein. He's one of our 12 managing partners, one of our 12 owners of the firm. He, as Richard kind of alluded to, he joined Bessemer nearly 20 years ago as an analyst and became the youngest managing partner in our history. He has had success at the early stage, backing companies like Procore, which had a very successful IPO. And he's also had success at the growth stage, investing in companies like Ramp, Ramp, Litify, and Restaurant 365. He is now one of the co-heads of growth that Richard alluded to. I just want to say and just reiterate that we're very proud to be partners with the New Mexico State Investment Council. We don't take for granted what this capital is for. Obviously, it supports the citizens of the state, but it plays a meaningful part in supporting public education here. And so that long-term goal that you all have is very aligned with how we think about generating long-term returns for our LPs. I'm just going to do a very quick reorientation and then turn it over to Brian to talk about how we're investing. But just as a reminder, we take our history back to 1911 as the family office for Henry Phipps, the co-founder of Carnegie Steel. In 1981, the investment team at that family office spun out to become Bessemer Venture Partners. Since then, we have invested across every major technology shift, from semiconductors to PCs, to the early internet, to mobile, to cloud, and of course now AI. We have over 20 billion in assets under management. As Richard mentioned, we have 8 global offices spanning the globe, and where there's innovation and technology hubs around the world. We have delivered 160 IPOs, over 330 successful M&As and private sales. And since 2021, which has been an historically challenged period for liquidity, we delivered 80 exits and 25 IPOs. Before I turn over to Brian, if you just take one thing away from today, and it was alluded to, the pattern recognition that we've been able to build over decades and decades investing in these paradigm shifts, and the access that our brand, track record, and networks afford us matters more today than it ever has. Brian's going to bring this a little bit to life, but just wanted to leave you with that. And I'll turn over to Brian to talk a little bit more about how we're investing.
Thanks, Anita. Let me begin by saying, it's a privilege to serve the people of New Mexico. Personal anecdote, this is my first time in Santa Fe, and it is beautiful. Anytime you need us to present, just give me a call. So as a reminder, we run 4 strategies at Bessemer. Each one started inside of our flagship fund, and we only spun it off when we had conviction that we could win. You've already supported us in 2 of those strategies. One is India 2, which is our early stage venture fund in India, one of the fastest growing economies in the world, and Forge 2, which is our technology buyout fund. Today, we're excited to grow the partnership with a potential investment in our flagship fund, BVP 13, which is an early stage venture fund, and Century 3, which is a late stage venture fund. When it comes to what makes Bessemer special, I'll highlight 3 things, some of which the team talked about. One, we empower everyone to make decisions, and that's unique. A lot of firms have a CEO or a CIO or a small group of people who are making the investment decisions. At Bessemer, all the early stage partners are empowered to make their own decisions. And that's powerful because when you're making these early stage investments, it's rarely obvious. And when we look back on our history, our best investments were often our least popular decisions. And so we want to empower our investors to build those roadmaps, to develop the investment thesis, to go out and find interesting companies and make those decisions. The empowerment allows us to do something else that's pretty special, which is have a culture of accountability. If you're empowered to make the decision, we can measure your performance. And so we have a large partnership with a lot of mobility. If you make good decisions, you can get promoted very quickly. And if you make bad decisions, you're shown the door. So we have a meritocratic, performance-oriented culture. And then the third thing that happens that makes Bessemer special is our stability. Like I said, we don't have founders, we don't have a CEO, we just have generations of partners. And when partners retire, they hand the keys over to the next generation with no residual economics. And that's really powerful because it ensures succession and generational transition. Today, we have 5 generations of partners investing side by side. And we've never had any messy successions. We've never had any managing partners leave who we've wanted to keep. It's a pretty remarkable institution that way. When it comes to our investment strategy, we take pride in what's called roadmap-driven investing. And so if you think about the venture capital landscape, on one end of the spectrum is what I would describe as kind of reactive network-driven investing. You know, you got a great network in Silicon Valley, your friends are calling you up saying you should look at this company. That's kind of one end of the spectrum. On the other end of the spectrum is roadmap-driven investing. And that is a thesis-driven approach where each partner at Bessemer is looking at the world and trying to identify a discontinuity in technology, building a thesis around it, and then going out and finding all the companies that align with that technological shift. And ideally, you're building relationships long before, you know, the round is coming together, so you're showing up with a prepared mind, and you're able to win and make better decisions as a result. And so if you look at the pack, you'll see in slide 6, we have a visualization of all our roadmaps. We call it the Atlas, and it's a representation of what everyone at Bessemer is focused on today. Probably comes as no surprise. If you look at the Atlas, you'll see a lot of AI. We've been through many generations of platform shifts. You know, I've personally been through 3 over the course of almost 20 years at Bessemer. This is the biggest one we've seen. The growth rates are unprecedented. The scale of market opportunity is unprecedented. This is real, and it's extraordinary, and it's only available through the private markets today. And so we believe that our scale, our success, our history of success, our brand, our relationships, our network enables us to invest successfully in this new platform shift. No one knows how this AI cycle is going to play out. Anyone who tells you they've got the crystal ball, you know, you should be skeptical. But what you can underwrite is a group of people who have been through multiple generational transitions in technology and can help navigate it with prudence and success. We've been doing this for a long time, and we're honored to be, you know, trusted stewards of your capital.
Thank you for that presentation. Are there questions on the Bessemer Venture Partners fund opportunities before us today? Treasurer.
A quick question just to clarify. I think I know the answer already, but this is $3 billion, and this is the beginning of this fund. Is that right? And I saw something on the notes from Mercer that I thought would be good to bring attention to. Don't worry, it's nothing secretive. On the why. And I thought the why mattered because a couple years ago when I had just started, we were saying it's hard to get people to come here to SIC. It's hard to negotiate fees. And I'm thinking, know your worth and da, 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 da. And what I saw in here is the fund leverage was the reason why. The firm intends to use the credit line to ease the capital call process. And I thought that was an important concept to put in this paperwork because now we are the leader and people are coming to us all the time. I know because I get the emails and I forward them to John and Kristen. And so I think that's a really important thing to think about because when we've talked about, and I've said this several times, we need to stop thinking poor. Now as the second largest sovereign wealth fund and increasing, we have a lot of opportunity to invest in things, not just at the end tail of it, but at the beginning of it. And so I just wanted to make sure and point it out to the council. That's all I had. Thank you.
Thank you very much. Are there additional comments or questions? Hearing none, is there a motion? Yeah, Member Roman, I believe, was going to offer that.
Based on the recommendations of the Council Investment Committee, Advisor Mercer and SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council approve a total commitment of $75 million to Bessemer Venture Partners 8 Institutional LP and $75 million to Bessemer Venture Partners Century Fund 3 Institutional LP, subject to and contingent to New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we have a motion and a second. Is there any discussion on the motion? Hearing none, could we take a roll call vote, please?
Treasurer Laura M. Montoya,
Yes.
Nick Teas,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer. Yes. Mary Roman.
Yes.
That's 7 in the affirmative. Motion passes.
Thank you.
Thank you.
Thanks for being here. Okay, we will now move on to item 3C. Private Debt Opportunities, 6th Street Partners, Tau 6, with Director Lofton and Makita.
All right, thank you, Mr. Chair. Members of the council, I believe we are on page 157 of your packet. This is a recommendation to commit $450 million to 6th Street TAL Partners, or we'll call it TAL 6.0 or TAL 6, and to roll our or SIC's prior TAL vintage commitments into TAL 6. This is an upsize in exposure to the TAL strategy and a roll of SIC's existing investments in prior TAL vintages into the current vintage, which is TAL 6. And these are prior commitments that the council has committed and total to $350 million across the 2 prior TAL vintages. The TAL Global Strategy vintages are evergreen vehicles in which respective called and invested commitments are reinvested until elected by the limited partner for distribution. SIC has invested with 6th Street since 2013 and since 2018 in the TAL strategy. Staff views 6th Street as a high conviction manager and the TAL strategy as a high conviction strategy. 6th Street is a global credit investment platform, one of the larger ones out there. They have over $135 billion in assets under management. It's across a range of public and private credit strategies. This TAL strategy is essentially a best ideas strategy across the firm. TAL pursues opportunities across the 6th Street platform, investments that are attractive that are on a risk-reward basis. Portfolio construction follows really 4 tenets: diversification and theme rotation, which involves bespoke structures, downside protection and loss avoidance, and steady cash-driven, less correlated returns. The strategy investments have generated a very solid performance relative to private credit peer sets and public alternatives. Our or SIC's 2 prior TAL commitments, each TAL 5 and TAL contingent, have both generated near 13% net IRR as of the end of the first quarter of this year. And really important for credit underwriting, and I think important really for one of the more important points to make for debt underwriting and debt investments in general, is that the TAL strategy has a very low 0.3% average annual loss rate versus something close to 90 basis points for the industry as a whole. So really good underwriting record. Really with this recommendation, the upsize to the strategy and the role of the prior commitments, we have two major things that we want to accomplish here. One, we want to continue our relationship with a strong conviction manager and a increase exposure to a strategy that is performed very solidly for SIC. And then secondly, we want to take advantage of SIC's increased size to achieve materially improved economics, both for the opportunity to invest the new money as well as to reprice our prior investments. TAL's economics are partially tiered between what they call a short and a long-term investor, which means a 3.5 or 5.5 year initial commitment period before the LP can elect to roll or have their funds distributed. This recommendation is based on the 5.5 year commitment or a long-term limited partner. Frankly, given SIC's high liquidity and the opportunistic nature of the strategy, this may require a longer period of capital deployment. On the, just to qualify the recommendation a little here, I do need to point out that TAL 6, and I'm sure Mary will elaborate, does have what's called a deal-by-deal carry crystallization structure. Normally, SIC would like to see a whole fund performance as the driver for carry to the manager, but frankly, a deal-by-deal is not uncommon for an evergreen vehicle. And then secondly, I view this, frankly, as it's often pointed out that the TAL strategy allows for very broad manager discretion across its platform. Frankly, I view that as also one of the advantages for this platform, in that it does give them so much flexibility to find opportunities in the market across the entire Sixth Street platform. So with that, I'm going to turn it over to Mary.
Great. Great. Thank you, Tom, and thank you to the members. In the interest of time, given that this is also a re-up, I'm just going to jump forward and outline the strengths and concerns and associate mitigants and defer to the GP to highlight the strategy as appropriate. As you know, we typically have income-oriented strategies, many of which we've brought to you, and then we have some strategies that are more capital appreciation focused and more MOIC focused. And we would highlight that this is one of the more MOIC-focused strategies. And what we would note for you, and Tom has already highlighted, the consistency of the performance. So if you look vintage by vintage across this strategy, the manager has generated a 1.5 to 1.6 multiple on invested capital. That ranks near the top quartile across vintages, and it's one of the key reasons why we're comfortable bringing this forward to you. Tom used a slightly different metric that I'm going to use, but it ties to the same idea of the very, very low loss rate associated with this strategy. So 1.4 on a cumulative basis. One of the key drivers, so we're credit investors at heart, and so the cash yield is of key importance to us. So since 2014, the long-term cash yield of this strategy has averaged 7%. So the limited loss and the consistency of performance and the focus on MOIC is one of the key reasons why we're bringing this forward to you and comfortable with it. One of the key differences of this vintage relative to past vintages is it is targeting a slightly higher IRR, which is provided that the manager can deliver on that. Obviously, that's a net positive. So this is targeting a 12 to 14% net. Tom's already alluded to this, the breadth of the strategy. The GP talks about hunting grounds. We would just say strategies, I think. But there are 7 core strategies that the manager utilizes, and it's incredibly broad. So from direct lending, sports and live entertainment, asset-based financing, real assets or real estate, dislocated public credit, late stage growth financing. Really that breadth of the strategy type coupled with the breadth of execution. So you will see first lien investments, you will see investments across the capital structure, and the GP is incredibly good at structuring their investments. So those are all key important things. To execute a strategy of such breadth, of course, the manager needs to have extensive resources, and they have over 700 professionals, excuse me. So one of the largest managers in the alternative credit space. So concerns. So things that we would draw to your attention and highlight. Some of the terms of the fund, they're just not very LP friendly. The treasurer is nodding. So some things that we certainly would draw to your attention is the pref. It's a 5% preferred return. Market standard is 7%. Why is that? You can obviously ask the GP for that. Part of it does tie to the vehicle structure and the fact that this vehicle has been around a long time, and so it ties to just where rates have been at. But that's certainly something to push back. There's a relatively low GP commit. Part of that has to do with just the size and scale of the fund, but that's something that we would draw to your attention. That deal by deal carry structure is something that Tom's already alluded to, and certainly something that we have a strong preference for, more of a European waterfall. However, one of the things that makes that effectively very difficult, if not impossible to execute, is the vehicle structure associated with this. So one of the mitigants and one of the reasons that we're able to get comfortable with that deal by deal structure is, one, just the realized very, very low loss rate that the GP has effectuated. But two is they do have an interim clawback where you basically have a look back, and we can go into the details around that if you want, or certainly you can probe more on the GP. We would highlight that the GP has experienced tremendous growth, and I'll let them highlight how they've been able to execute on that. The vehicle structure is complicated. There is absolutely no question about it, but it's also kind of core to that ability to recycle the capital and deliver that high multiple and invested capital. You've articulated to us multiple times that you want us to find strategies that focus on compounding, and core to that is part and parcel, I should say, is the vehicle structure, which allows the manager to execute on that. So I'm going to stop and turn it over to the GP to go into greater detail.
First of all, thank you all for having us down here today. I'm going to go a little off script. John will probably kick me under the table for this. I've had the pleasure of coming here for over 10 years for business reasons. Santa Fe has actually become a pretty important personal place to me. My daughter, Molly, and I took a father-daughter trip here last year. We did some ghost ranch action, if any of you have been out there, and I had to fight her off on Sunday night. Otherwise, Molly would be sitting here with me, but I told her she had to go to school. So it's a pleasure to come here. Sincerely, I come here a couple of times a year, and now I make some personal trips here as well. Number two, thank you so much for the partnership. We have a large firm. We have a lot of capabilities, things like that, but we've built our firm with a core group of very large institutional LPs that are 300-400 LPs around the world. We do not run massive retail funds with thousands of underlying LPs and fund of funds and things like that. And our implicit connection and partnership is we build long-term partnerships with people like you all. We work super hard. We work our tails off to hopefully generate great returns for you and your beneficiaries. And thank you so much for entrusting us over the last 8-9 years with a partnership, especially in our flagship vehicle. As has already been said, TAO is our flagship vehicle. It is a single vehicle of risk that spans everything we do in 6th Street. Every theme, every business unit, every sector, all dynamically allocating across the different themes, business units, and opportunities across the firm. You've already heard from Tom, you've heard from Mary, and this is obviously a re-up today. And so if folks would like a refresher of what TAO is, anything on the firm, I'm happy to go in that direction. or I can pause here, answer any questions that anybody has here. But again, thank you so much for the partnership. And again, please tell me if you'd like to go in that direction or just go right to questions.
Why don't we move to questions? And I suspect we may have questions along those lines. Are there questions?
Mr. Chair, I would appreciate a very brief refresher.
No problem. So I'll try to do two things in one. I'll try to just quickly give you a brief refresher of 6th Street because it actually matters to the brief refresher of Tao. So 6th Street was founded on the heels of the great financial crisis in March of 2009. Prior to that, our founding partner group had been managing one of the largest on-balance sheet bank investment businesses that had ever existed from the late 90s till we left in 2009. Dodd-Frank, Volcker, financial regulation effectively changed the way banks can keep investing in prop businesses. And so literally we just basically took everybody who ran those businesses to reconstitute out of a bank. And that was the beginning of 6th Street in March of 2009. You fast forward the clock 16 or 17 years later, 6th Street, we have grown into, I believe, the 10th or largest of the alternative investment firms. Interestingly enough, I believe we are now the largest who is not public, nor are we a subsidiary of a larger asset manager. So a little bit different in that regard. We have about 900 people around the world. Most of our investing activity is going to be developed markets focused. So we're primarily going to be investing North America, Europe, that will opportunistically go in other directions. And there's two kind of hallmarks to how 6th Street invests, which is constitutionally important, not just into understanding Tao, but kind of the human beings who are managing capital here. Number one is, in a world where I see a lot of managers evolving into becoming more of a financial supermarket whose incentive is just to sell as many products as they can every single day, for better or worse, 6th Street is just the opposite. We have a saying, which is we are an investor first culture. This is still just a hardcore investment firm. We have people here who wake up in the morning, go to sleep every night. All they're thinking about is investing in deals and things like that. It's not about AUM growth and product launches and all of this. We still operate very much as an investor first culture. Every investment we make in our funds is specifically in a theme we're trying to drive risk into our portfolios. And number two, this has already been touched on, but there is a maniacal focus on downside protection, compounding capital, limiting losses. In fact, in our 26 years as a partner group, between our days at the bank, days here, we have never had a down year in 26 years as a partner group. And so not only is it people who love investing, but number two, compounding capital, limiting losses, those are two kind of hallmarks. And so as we get to Tao, that backdrop is pretty important. We started building Tao right after we founded our firm with originally 10 of our largest LPs worldwide. And the idea was to have a singular vehicle that spanned the entire ecosystem of kind of private credit opportunistic investing. And so rather than just say, hey, let's go into a direct lending fund, or let's go into a distressed fund, or let's go into a mezzanine lending fund, the idea is in this whole ecosystem of private credit, which is 50 or 60 underlying sub-asset classes, take all the expertise, the people, the business units to say at a moment in time, a mezzanine loan might be the most interesting thing to do. At a different moment in time, a distressed transaction might be the most interesting thing to do. At a different moment in time, a healthcare royalty transaction or a direct lending vehicle, but don't get stuck doing one thing over and over and over. And since that original idea 14, 15 years ago, we're really humbled and proud of this. But Tao has grown into one of the largest, if not the largest, opportunistic private credit fund in the world, where for many of the largest state pension funds, sovereign wealth funds, insurance companies, it has become a cornerstone of their whole private credit holding for the simple reason of it's always moving in and out of this ecosystem's components, going into areas and themes when they become mispriced, but moving out as capital flows in them, again, rather than a strategy-specific fund where you're always buying the same asset over and over and over. So I tried to do that, by the way, in a shorter, condensed version, so apologies if I was going a little quick, but hopefully that gives a good overview. Thank you for the question.
Are there additional questions? Madam Treasurer.
I do. Welcome back. I do remember you. And I remember our conversation. Just for clarification, it's we've invested $625 million, And the last investment in 2025 fund, and I'm going to say V1, because that's still 6, but is that different from this 6?
That is different from this one, yes.
Okay, I thought so because normally we wouldn't. So that one was 100 million, and everything that we've invested before, we've looked at what the returns have been since then on the vintage years, and we've aligned, correct?
Correct.
Okay, so the only thing I'm gonna mention, because I appreciated last time the amount of diversification, 2 things. One, on Mary Bates Point, I'd like you to talk to us a little bit about that 5% aspect, because I'm trying to understand better.
Absolutely.
Yes.
And was there a second question too, or just?
Yeah,
that?
but that's an easier one.
Okay, got it. So we built Tau a long time ago. As I just said in the history of it, we started building it 14 years ago. And it is a singular vehicle that we have grown over time with you all, obviously, and other investors. And so when we formed Tau originally, we negotiated the original overall package of economics with our original LPs. And there's no singular term that myself or anybody at Sixth Street was wedded to. There's management fees, there's clawbacks, there's incentive fees, there's all sorts of things. And the origin of Tau, our investors said, look, we really want to do this with you. We would appreciate it if you could have a better incentive fee than a traditional 20% promote. We also would appreciate, unlike some of our other funds that have fees and committed capital, if this had fees and invested capital. We also would appreciate if we had tiers for different sizes, fees, things like that. The whole thing was a package. And so we said, no problem. We're happy to do that, which is why you have a more favorable promote than a traditional 20%. There are no fees on committed capital. Well, I'll get to the fee tiers you're going to get into. And we have tiers for the management fees. As it related to the pref, obviously, as Tom and Mary alluded to, when we formed this, interest rates are at 0%. And number 2, we said in exchange for that, we just simply want to get into the promote quicker. Had nothing to do with the expected returns or things like that. But if we're going to take a lower promote, it actually just allows us to get into the promote faster than otherwise. That vehicle has obviously grown and evolved. And so at this point in the vehicle, there are limits to what we can change or not change because it would trigger changes for the entire vehicle since inception. Now, Tom can speak to this, but in conjunction with this upsize, we're also creating an option for you in the future that would in fact change the pref higher for you all. And so that's something we wanted to do with you in relation to this upsize we're doing right now. So I don't know if you want to comment on that.
Yes, Treasurer. So just to clarify, we'll call it the rack rate is 5% for giving us the option to roll the prior commitments into 6 along with the new commit. Our pref is actually going to increase to 6, and we're going to have the optionality if we see that that the investments that Tau is making are performing well, we'll have the optionality next year to go to the 7% tier if we so choose.
So we know that's a concern of yours that Tom has raised. So we tried to create a pathway. So for the ones that out for you all, you are going to benefit from a better pref than you've historically had, to Tom's point. And number 2, should you want to keep increasing over time, you'll even get better from there.
I saw that.
Yep.
I saw that number. Thank you. And then the last question I have, your daughter will appreciate this one. I'm reading the report and I didn't even know that these numbers actually existed on a median of 25% for minority representation. You're above that on the quartile. So didn't know it was that low, but congratulations. But on the gender representation being more fixed relative to the benchmark, and I see your person on here smiling because I remember meeting her before too.
We have my partner and literally one of my best friends, Asha.
Yes. Yeah.
She's one of our partners. We've worked together for 15 years who visited you all last time.
Yes.
She insisted that she had to join. She didn't let me just get this all by myself. So, but I
I'm
took the
glad
trip
she did
this time.
because I remembered her and that's what made me remember you all. And so gender representation is more mixed relative to benchmark. Female representation across the entire staff is 32%, which is below the median of 37%, but remains above the bottom quartile. But in the investment group, females represent only 13.3%, but I noticed somewhere else you've increased by 40% in your employees. And so I just wanted to point out, when we decide, Tom, to come back, I want to remember that these numbers are going to be more beautiful in the next go round for us to deploy that much money, which would take us over the billion, I believe, correct, right now?
Not yet, Treasurer. Right now, this would take us to 800 total in TAL 6. If we're satisfied with how TAL 6 is performing, next year we can add another, we have the option to add another 200 to get to the 1 billion tier that would then take us to the 7%.
Okay, but in total with them,
Oh, in total.
we are already over
Yes.
$1 billion.
Yes, ma'am.
Correct. So this is a great long-term partnership that we've had. And so I'm just making comment to the fact that in New Mexico being a minority state, and I think the men are almost a minority right now up here, it's important to have a reflection of that within our teams. So thank you.
Absolutely.
Thank you.
Thank you. Are there additional questions? Hearing none, do you have a motion, Member Roman?
Based on the recommendations of the Council Investment Committee, Advisor Makita, SIC staff, and general fiduciary oversight from RVK, I move that the State Investment Council approve a commitment of up to $450 million to Sixth Street TAO partners enrolled prior TAO commitments into TAO 6. This commitment is subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second the motion.
Okay, we have a motion and a second. Is there any discussion on the motion? Hearing none, could we have a roll call vote, please?
Treasurer Lori Montoya,
Yes.
Nick Teas,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
Mary Roman.
Yes.
7 in the affirmative, motion passes.
Okay, thank you. Thank you for being here.
Thank you so much.
Okay, that takes us to item 3D, the consent agenda, re-ups and co-invests with existing managers. Was Director Sable going to lead this one? Okay, we'll recognize Director Sable. Okay, please proceed.
Thank you, Mr. Chair. We're here to make a recommendation that council commit up to $125 million in Macquarie Infrastructure Partners 7 alongside a $125 million co-investment sidecar. Joining me for this presentation is Gurjeet from Mercer. And then online, we have Trevor Bloom, MD for Client Services for Macquarie, and Jenny Chan, who's a senior MD and head of portfolio strategy for the MIPS strategy. This is a longstanding relationship for SIC. We have made, this would be the 6th commitment to a Macquarie fund, the 4th in this series. The last was a $100 million commitment to the 2022 vintage. Committed unfunded capital plus NAV is $535 million for the strategy. This remains a core plus strategy with a 10 to 12% net return target. Gross yields are expected to be in the 4 to 6% range. This is broadly consistent with a core plus style of investing. Macquarie's one of the better known names in infrastructure investing, perhaps the first firm to invest in infrastructure. Currently, they're managing about $635 billion globally, $233 billion in real assets, approximately $45 billion of which is in North American infrastructure. The Macquarie Infrastructure platform focuses on North American investments, 80% North America, 20% in Latin America. That business is located in New York City. In terms of sector focus, it's a broadly diversified portfolio that'll be focused across transportation, digital infrastructure, utilities, and energy. The performance of the fund series has been consistent with expectations. The prior 3 vintages we're all within target ranges, and vintage 6 is early in its life cycle, but deploying as expected. One of the key details that we like about Macquarie, one was the access to significant amounts of co-invest, and then also they manage the portfolio on a European style whole of fund fee structure, and they also do some pricing on management fees that mitigates the J curve. And so for all of these reasons, we are recommending the commitment that we outlined, 125 million in the main fund and 125 million in the co-invest. With that, I'll hand over to Gurjeet, and then when he's made his comments, at your option, we can have the management team make a brief presentation or just be available for questions should you prefer to do that.
Thank you, Keith. Thank you, Mr. Chair, council members. Again, as Keith mentioned, we're presenting Macquarie today. The SIC has committed 300 million to the prior 3 funds. That's generated a net IRR of 11%, which is right in their target profile of 10 to 12%. They're seeking to raise $7 billion for Macquarie Infrastructure Partner 7, which is their Core Plus North American Infrastructure series that dates back to 2003. Now, things that we like about the firm, they've kept the fund size broadly the same between Fund 5, 6, and 7. And this is a positive because given the industry trend towards larger fund sizes. The manager has a large and experienced team of 60 investment professionals that will be focused on the fund, and it'll follow a similar strategy to prior funds, focusing on assets in the US and Canada across transportation, utilities and energy, communications, and waste management sectors. Now, as Keith mentioned, from a portfolio construction perspective, the fund will make 10 to 15 investments, broadly diversified, across its target sectors. And the target sectors, as Keith mentioned, transportation really refers to roads, ports, rails, airports, utilities and energy, utilities and midstream, communications, fiber, wireless networks, data centers, and waste management, solid waste disposal assets. From a track record perspective, the depth and length of the track record really makes Macquarie one of the most established investors that's solely focused on the Americas, and performance of their more seasoned and fully realized prior funds have been really strong relative to its peer group, ranking mostly in the first and second quartile. Now, again, as Keith mentioned, we're recommending a commitment of up to $125 million to Macquarie Infrastructure Partners 7, along with a $125 million commitment to a no-fee, no-carry co-investment sidecar. And as Keith mentioned, we do have the Macquarie team online and happy to have them do a short presentation or dive into questions.
Thank you. I think for our re-ups, we are going to bypass the manager presentation and move straight to questions. Is that correct?
Mr. Chair, that has been our precedent.
Okay. So I'd like to continue with that if members are good with that, and move to any questions that members have on the Macquarie opportunity.
Mr. Chairman, just one point of clarification. You said 300 million. Is it 300?
100 for each prior fund that we've done in the, you mean the historical funds?
Yes.
Yeah, it was 100 to Fund 4, 100 to Fund 5, and 100 to Fund 6. So 300 in aggregate across the 3 prior funds.
Got my cheat sheet said 425. Okay. That's all I had, Chairman.
Okay. Are there additional questions on the Macquarie opportunity? Okay, hearing none, I think since this is on the consent agenda, we will now move to the Airmont Capital Real Estate Fund 6 re-up, and then take a motion on the consent agenda after that discussion.
Thank you very much.
Thank you.
Recognize Director Sable.
Thank you, Mr. Chair. We're in conjunction with Townsend recommending a commitment of up to 150 million euros to Airmont Capital Real Estate Fund 6. This is a pan-European opportunistic real estate strategy that is targeting $5 billion for its raise. This would be the 3rd commitment to this management group, which was previously known as Perella Weinberg at the time we made our initial investments. The remaining NAV plus unfunded capital in this series of commitments is $110 million. Airmont Capital is a leading European real estate manager founded in 2007 headquartered in London and Luxembourg. The strategy is, again, a pan-European opportunistic strategy targeting direct assets, corporate and real estate credit-related investments. They're focused on prime assets and transformational projects, typically in major Western European cities. The fund expects to make 11 to 14 investments each in the 250 to 450 million euro range. It's been an extremely strong performing fund in the opportunistic space in Europe. Composite net IRR across their prior fund series, 15% with a net multiple of 1.6. The early vintage funds 1 through 3 are largely or fully realized, each of those generating top quartile net returns. More recent funds have faced a bit more volatile environment, including the COVID-19 and rising rates subsequent to that. But performance in those funds has been very resilient. The most recent fund is currently expected to deliver something around an 18% IRR and a 1.8 multiple. One of the things that we like about the strategy in particular is the platform's ability to adapt the strategy to preserve value under stressful times like we had talked about earlier, and its resilience supports continued confidence in this opportunistic mandate. I think I'll pause there and let Rob make his comments.
Hello, good morning, everybody at the council. Yes, we're recommending 150 million euro commitment to Airmont Partners Fund 6. I think I just want to touch on three topics. First is, we encourage you all to think of real estate globally, not just in the U.S. And just a real quick primer on your European portfolio. You have about 16% of your real estate is invested in overseas markets already. About 12% of that is invested in Europe. You have 4 key managers there that we see as good strategic partnerships, and they're all complementary in terms of their strategy. Airmont is one of those. Ironically, you've committed to 2 out of the last 5 funds with Airmont. When we came on board with you back in 2011, 2012, Airmont was one of our earlier investments that we recommended. That was Fund 2. At Funds 3 and Funds 5, you skip primarily because of some staffing changes and things like that at SIC, so you were not really positioned to make new commitments. You missed those vintages. So you're in Funds 2 and 4. Today we're recommending Fund 6. Why go global with your real estate? You have a U.S. focused program, a U.S. focused benchmark. We think it's good for diversification in the program. We think it increases the opportunity set of investments that are available to you. We look at over the last 5 years, the European portfolio that you have actually was accretive to your performance by about 60 basis points after fees, and that includes a lot of fluctuation in the currency exchange. So we think overall it's a good thing to have some of that overseas exposure in your program, especially as you tilt towards more growth-oriented strategies in the program, versus the core stabilized that you had previously. We think Airmont, the one thing that stands out from a positive perspective with this platform is we think there's a really good alignment of interests, the way they structure their compensation, the way they distribute the promote broadly across the firm, the way it vests over 5 to 6 year period. So the promote for this fund will not be distributed to the full team until after they fundraise, and it won't completely vest until 2032, 2033. So that really is a good retention tool for the team. One last issue that is a concern, but it's also a positive, is the firm is transitioning its ownership. And so Fund 6 will be the last fund under the, kind of the old ownership, if you will, at Airmont. The firm sold a 50% interest in the firm. Airmont sold a 50% interest in the firm to Keppel, which is a Singapore-based asset management firm that's looking to grow its presence in Europe. They sold that 50% interest in 2024. They expect to sell the additional 50% and complete that in 2028. The deal is structured from our perspective. We got comfortable with it in a pretty good way. Fund 6 is more or less ring-fenced. The management team will stay in control of Fund 6. Keppel has some controls over the broad management of the overall platform, but in terms of the investment decision-making in Fund 6, that'll be handled by the existing team at Airmont. And the transaction was really started in connection with the succession plan from the original founder of this platform, who unfortunately passed away in 2024, right in the middle of this transaction. But he was transitioning ownership and control at that time when they started discussions with Keppel back in 2023. I think a couple of other comments about the Keppel transaction. Again, the 50% that will be sold in 2028 doesn't vest with the team. I'm sorry, the proceeds from that don't really vest until 2030. Again, pretty well distributed across the team. And the team at Airmont was able to increase the share of promoted interest that they will take from Fund 6 from the prior structure that they had with the primary owner who was retiring and passing away. So they've increased the alignment of interest when it comes to the promoted interest and how that's shared across the firm in connection with the Keppel transaction. So with that, we recommend a 150 million euro commitment to Fund 6 at Airmont. And Nathan Scheich is here, one of the key partners and owners at Airmont, and is available to answer questions and can make a short presentation if you so desire.
Okay, thank you for being here. Thanks for that discussion. And I think consistent with our practice for re-ups, we will respectfully pass on the presentation, but should ask for any questions that people have on the Airmont opportunity. Member Summer?
Mr. Chair, could you explain in a little more detail the couple partnership and what's going to happen at the end of this term? Are we going to have a new general partner, 100% controlled by a new group?
Yeah, and I'll let Nathan answer it, but yeah, that it will be 100% owned by Keppel in 2028. And Nathan, you want to add any comments on that?
Sure. No, thank you for the question. It's a key one, and I'm happy to hopefully clarify it. We've been an independent business for many years, and I have to say independent life is very good. You know, a business that's wholly owned, has been wholly owned by 5 executive partners. We've been exclusively focused on trying to be really good at one strategy, which is pan-European opportunistic investment, as Keith noted, focusing on creating prime assets in cities or leading platforms in growth sectors. So we've really stuck to our knitting, only one flagship fund series. We're very proud to have had you along as partners. I have you as partners for 2 of those funds, and appreciate the opportunity to talk about the next one. So we were independent for most of our history. You know, I'd say 3 to 5 years ago, there started to be a real wave of GP consolidation in our sector. I don't think just specific to real estate, but more broadly. We looked at that without much interest for most of the time, but we did feel that we should have an open mind if we were approached by a partner that we felt could bring something to the table to us that we could utilize to be a better investor, at least in certain areas. But likewise, we feel we've developed a very specific and very successful investment culture over the years. Operational expertise, discipline, integrity, I would say, are the 3 hallmarks of that culture. And we were very wary of doing anything with a group that might disrupt that. Many of the groups that approached us were some of the big multi-strategy managers, particularly some from the US. Very impressive groups, some of them great people, but groups that already had a big presence in Europe, where we felt there was a risk of being absorbed into an existing business, losing the culture a bit, and losing control over the management of the funds and, importantly, the team. So we politely declined those entrees. I should say we never hired a bank or solicited interest. We were approached by Keppel, which is a leading business in Singapore who focuses on energy infrastructure, digital infrastructure, and real estate, primarily in Asia. It's a firm that's been around for some 60 years, really with an industrial background. So not financial allocators, but more industrial operators, teams of engineers creating assets, creating value in a manner that really appealed to us in some ways. Likewise, Keppel had no asset management footprint in Europe, so there was not the similar risk of being absorbed into an existing larger group. And Keppel was very happy to accept an arrangement whereby we effectively retain full control of all the existing funds and any fund that's raised before 2028. What's important is that we refer to that as the ring fencing, which I think was mentioned. The ring fencing applies through the life of the fund. The ring fencing requires that we fully control the investment committee, we control the management of the team and operations, fund management, asset management, and so on. That fully vests with the existing Airmont team. And that, despite a subsequent economic transaction happening in 2028, that ring fencing will apply until Fund 6 is liquidated, let's say some 8 to 10 years from now. The way we look at the future, though, because of course to us as the partners who've built the business together and have a lot of pride in the business, we want to be here for the very long term. We have no intention that this is an event that results in retirement or leaving. To the contrary, we're making by far the biggest personal investments we've made in any Airmont fund in Fund 6. We expect and intend to continue doing that in Fund 7 and onwards. And frankly, I think as with anything in our industry, we have to do two things well. We have to treat investors with the utmost respect and ensure that you enjoy working with us and feel that you have the transparency you need to understand what we're doing, and we have to generate great returns. And our view is as long as we can continue doing that, there shouldn't be that much change in the future, even for Fund 7 and beyond, in terms of how this business operates. And that's very much what I'm personally expecting to be the case.
Mr. Chair, thank you. You explained ring fenced management. I was going to ask you what that was, but thank you.
Member Summer, if I might add, when we look at a transaction like this, we think of the world both from what's the impact in the short run over the time period that we're going to be investing, and then what next. And the what next is the part that we'll have to analyze before we bring this investment back again. And that'll make some assessments about how is that transaction unfolded? What does alignment look like then? For the immediate future, we're looking at a circumstance where, as Nathan has pointed out, the governance is actually ring fenced, and the incentives through increased economics are actually better than what they've been. And so that combination of factors leaves us comfortable that the prior track record is relevant for this fund.
Additional questions on Airmont? Madam Treasurer.
Hi.
Correct. Approximately, yeah, approximately 175 in dollars.
You had two prior commitments that were right around $75 million. These are euro-denominated funds, so your commitments are denominated in euros, but they were right around $75 million each for the prior two funds. And those were done back in 2012 and 2018. Roughly, yes, yeah. It's going to be about 5 billion target. 5 billion, yeah, euros. That'll be about, I think the exchange rate's around 108 today for $1.08 per euro. So 10%, roughly 10% more than that. So
Sure. We've recently held a first closing, and we are currently at over 1.3 billion euros. It's good to get clarification, and we realize when lawyers fill out subscription documents, sometimes we're confused too with the currency changes. So.
Before you,
Madam Chair, point of clarification, the Align Data Centers is a Macquarie investment, or was?
Some for that one, and then notes, and then it's moving into this one on this paper.
Chair and Madam Treasurer, we did have a conversation around data centers in this strategy as well. Member Tay has actually asked about kind of the impact considerations. We did inform the committee, the investment committee, that Airmont is a signer of the UNPRI and is a responsible investor focused on transparency and reporting. But Nathan, if you wouldn't mind just talking a little bit about the impact of data center investing and how you're going to focus on it in this next vintage year, that would be very helpful.
Sure, no, absolutely, and thank you for the question. It is a major topic today. It's an important one. Obviously, huge amounts of capital going into this sector very quickly. Lots of potential impacts on communities, on different sectors, and frankly, sociologically as well. So we do view data centers as a possible investment opportunity for Airmont in Europe. We have made one investment in the sector in our prior fund, not in a fund that you all are yet invested in. But when we look at data centers, we sort of distinguish between two different categories. One category, which I think is getting a lot of the headlines today, are these huge facilities that are being developed predominantly in the US and utilized by the so-called hyperscalers to train AI models. These are facilities that are physically very large, that are often in places that aren't used to having that type of infrastructure, and that are extremely power hungry, and therefore require huge amounts of power with a number of obvious knock-on effects potentially in the surrounding areas. Those types of data centers, it doesn't really matter where they are other than the scale and the power access, because they're not interacting with customers. So there's no question of how quickly does the computation happen in the center versus how quickly do we see it on our computer or on our phone. The other type of data center in the way we look at it are data centers used for cloud infrastructure. So that's kind of the plumbing of the modern digital era, whereas we all use computers and smartphones every day. Whenever we're doing something there, usually the computation happens in a data center. It has to be close to the population center, so there's a low so-called latency, and so on. We in Europe are almost exclusively focused on the latter category. We have not, and nor do we have any intention at the moment, to invest in the kind of mega, huge data centers that I think perhaps, and excuse me if I'm wrong, might be more of what is the concern comes from in terms of headline risk and other risks. We are focused on cloud infrastructure data centers in or around major cities. In our fifth fund, so the most recent fund, we've made an investment in a platform in Spain, which is the leading player in Spain for these types of cloud infrastructure data centers. We have a big project in Madrid, for example, on the outskirts of Madrid, where you already have a very established data center, and it's actually an extension of something that's already there. I would guess, and in fact, in terms of pipeline opportunities we've looked at, we have exclusively continued to focus on that type of cloud infrastructure data center, which is usually smaller, more like traditional real estate, and that location is key. It's very difficult to get zoning and planning permission. There's a lot of community input when that happens. And I think that's where, first of all, we see the best risk-adjusted return. We don't see as much of an obsolescence risk as you might have in the other larger facilities, and where we see the greatest supply-demand imbalance today, rather than an imbalance that requires incredible projections into the future. We do. Yeah, and we've realized, I would say, we sort of accidentally became very focused on ESG very early on because, as Keith kindly mentioned, our aspiration has always been to create prime assets or leading businesses, and leading businesses is a fancy way of saying companies with great real estate. In Europe, which has long prioritized strong ESG credentials, whether it's from tenants or investors, if we want to create prime assets that are going to be attractive to the groups who are going to pay us the most in rent or exit, we've long had to deliver a great ESG offering. So I would say this has always been a hallmark of how Airmont invested. So as ESG has become far more of a let's say topical, issue in the industry, I think rightly so, we have been able to relatively seamlessly transition from what we were doing anyway into what is a very convoluted landscape of acronyms and reporting and standardizations. The CREM pathway is something that's used in Europe. I'm not sure to what extent it's really referred to in the US, which has to do with the age of a real estate asset. And as that age progresses, the extent to which more carbon is produced and let's say the impact on the environment deteriorates. So it's something that investors will look at when we go to sell an asset, particularly if we're targeting sophisticated institutions in Europe. And therefore, it's something we look at in terms of wanting to present a good story that we've created something that isn't just performing well today from a commercial and ESG perspective, but for the next investor, they will enjoy, so to speak, a strong ESG performance for years into the future.
Thank you. And then the last comment was just, I appreciated the pictures and design of your team because I think that helps bring in good returns. That was all I had on that. And I'll yield back. But if we're done with that conversation, I just have a question for you.
Okay. Are there any additional questions on Airmont? Okay, Madam Treasurer, what was your other
So
topic?
we have on the agenda two of them. I didn't ask the question and I meant to. On the previous one, that's a re-up on the data centers, and that was the one that I was looking at the wrong paperwork for that particular issue. And so I just wanted to be able to ask that question of them because, listen, I'm all about the money. So I'm not really in perspective right now of whether people like them or not like them. The last one that came before us, it was very thoughtful, it was very thorough, and we invested in it, and I voted yes. And I can explain to anyone who complains about it why I did after giving John a really hard time and the people that came before us. I don't care about that. What I do care about is that rate of return. And right now, there's been a lot of zoning issues. I've been hearing, I went to Oklahoma. There's been moratoriums. Red states are more stricter now on moratoriums on data centers and the access. And so as a fiduciary, I just care about my money. And so, I mean, I care about all the other stuff too somewhere else. But in this hat, in this role, I just really have questions about that. And so I don't know if they left or if you can talk to me about it.
Are the Macquarie representatives still on the line?
Yeah. Hey, Keith, yes, I'm on the line and Jenny's going to jump right back on.
Great.
Okay, Trevor, if you don't mind, Mr. Chair, let me make an introductory comment and
Go
then
right ahead.
maybe hand it over. So Macquarie's been a leading investor in infrastructure for a very long time. And in funds, I believe the vintages were 4 and 5, they had invested in a data center platform called Aligned, which ended up being one of the largest data center transactions actually in history, sold to another large GP consortium to basically be the basis for a more core-oriented strategy going forward. That will have returned to SIC over the coming months, something on the order of $140 million in distributions, basically a 4x plus multiple on that investment. If you look at the total incremental capital that we will deploy in this fund into data-oriented or data center-related investments, we're making a commitment of, say, 250 combined between the main fund and co-invest, and the fund would have on the order of 10 to 15 investments, and they would typically pick a platform to invest in. The likelihood is that we will have gotten more capital out than we will actually be redeploying in this individual investment. So I think I would pause there, and Trevor, perhaps if you wanted to weigh in.
Yeah, I see Jenny's joined as well. And just to recap, so Jenny is the head of the MIP portfolio strategy and also sits on our investment committee. Jenny, I know you were off during the discussion, but I think the general question is kind of what's our approach to kind of mitigating some of the community risk in data center development and maybe some of the history that we've had in the MIP series. Aligned was brought up as a successful exit and how we're kind of looking at investing in the sector going forward. Did I capture that correctly?
Yes.
Great.
Yeah, maybe I can respond to that, and Trevor, feel free to add. Um, we're very mindful of stakeholder considerations across all classes of our assets, not just data centers, and we need to be because infrastructure by definition provides essential services to the community for the effective functioning of the economy. So we are mindful of that across all of our assets. With data centers in particular, for the new assets that we're considering, we have been proactively structuring our transactions not to invest capital until we have more visibility around the ability to sort of develop a particular site in alignment with the community. So in MIP 6, for example, in which you're invested, and for MIP 7, where we're contemplating a co-investment into our new data center platform, which is called Applied Data Centers, our capital isn't invested until a customer lease has been signed and approved effectively at Macquarie's discretion. So at that point in time, the power interconnection, the site development, that should have been really developed and progressed in a way where we know that the community is willing to be willing to accept that project, if you like. Secondly, we want to choose the right market. So for Applied in particular, frontier markets have been a focus. So what that means is selecting land where generally there's lower population density, so it's less disruptive to the community. We're also selective about the type of technology our platforms are using. So Applied uses something called closed loop liquid cooling. Part of the benefit of that is it minimizes water usage for cooling. And we're also working with a range of partners who are committed to mitigate and limit ratepayer impacts. So our developers are generally, paying for the generation and transmission that's needed by the project. It's paid for either by the customer or the developer and not the community. We often also partner with the communities to make community investments alongside our projects. So I think to answer your question, we're clearly very mindful of that issue across all of our assets, but have tried to be thoughtful about it as it relates to data centers.
Mr. Chairman, the MIP 4 and 5 said aligned data centers. The MIP 6 says applied data centers. What's the difference between those two words?
Oh, that's correct. So Aligned was our hyperscale data center platform, which MIPS 4 and 5, the prior vintages, invested into. As may have been mentioned in the earlier discussion, we've now successfully sold that platform. It was $40 billion to a buyer, reached a very successful outcome for all of our investors, including New Mexico, which was invested in both of those funds. So we're on the way to really fully exiting the Aligned platform. Applied is our new data center platform that we've started to invest into out of initially MIP 6. Off the back of the successful leasing that platform has been able to generate, additional capital is required. And as a result, MIP 7 has committed additional capital to that new platform at this stage.
And Mr. Chairman, last question, because I don't want to take up more time, but do you have an ESG policy that has the accountability for best practices with data centers or any other type similar to what we were just reading?
Yeah, absolutely. Macquarie Asset Management as a business has really had a very long-standing range of environmental, social, and governance frameworks, which we use to assess new investments and how we manage ongoing asset management. So what we want to do is not to be green just for the sake of being green, but we know that there's a crossover with proper resource management and financial outcomes. So, you know, as Gurjit mentioned earlier, and Director Sable, we invest in 4 key sectors, being transport, digital, energy, and waste. And just as a simple example, within our waste businesses and other businesses, we often use a lot of trucks for the transportation of various items. One of the practices that we'll implement across our businesses is regular rerouting. And that's important because it reduces travel time, but it also reduces fuel usage and emissions all at the same time. That's one example on the environmental side. On the social side, there's a range of issues, but one of the issues that we care immensely about is the safety of our workforce. So across the MIP portfolio companies, it's about 30 portfolio companies currently. We have 60,000 employees and contractors working across those businesses, and we really want to proactively manage our processes to ensure people go home safely every day. And then lastly, you know, as we talked about, we're mindful of the nature of the services that we provide to the community. So we're very careful to manage our stakeholder relations, potential conflicts of interest, cybersecurity, and the like. And that has been our practice really since inception.
Thank you, Chairman.
Chair and Treasurer Montoya, if I might just add one thing, this manager is also a signer of UNPRI and is dedicated to transparency and responsible investment. What I will tell you more broadly, particularly in Director Sable's asset allocation, any investments here can impact community, can impact individuals and people. And responsible investment isn't something that we look at just for impact, but also how it can impact financial returns. So this team and the investments that we bring to you, particularly on the real tangible asset side, we will have a focus on managers sharing that same thought of responsible investing to manage risks within a portfolio while still not compromising financial returns.
Thank you. Thank you, Chairman.
Okay, thank you very much. Are there additional questions on either Airmont or Macquarie, the 2 items on the consent agenda today? Hearing none, I believe Member Roman has the motion for us on the consent agenda.
Based on the recommendations of the Council Investment Committee, SIC staff, advisors of Mercer, Townsend, and general fiduciary oversight of RVK, I move that the State Investment Council approve today's consent agenda commitments as reviewed and memorialized in today's meeting, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork. Real assets, Macquarie Infrastructure Partners 7, a re-up of $125 million, the main fund, and $125 million in the co-invest. Do you want to do both?
Yep, I think we,
Okay.
yep.
And real estate, Airmont Capital Real Estate Fund 6, a re-up 150 million euro in the main fund.
Second.
Okay, thank you. That's a motion and a second. Is there any discussion on that motion? Hearing none, could we have a roll call vote, please?
Treasurer Laura M. Montoya,
Yes.
Nick Tanis,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Sommer, Mary Roman.
Yes.
That's 7 in the affirmative. Motion passes.
Okay, thank you. Thanks for being available to answer questions. Let's move to section 4 of our agenda, governance matters, and begin with the third-party client program update and proposed IPS revisions. Recognize our Chief Investment Officer.
Chair and members of the council, once again, thank you so much for your time. Dawn and I are going to tag team this presentation, and what we realize and what you've seen in the performance reporting is our third-party clients are growing. exponentially within our portfolio. There's a long history here, which Don will help us all understand. And with that, what we're seeking to do is for the council to understand the benefits and the risks associated with this program. So with that, I'm going to hand it over to our Chief Investment Operations Officer, Don, to start us off.
Thank you, Kristen. Thank you, Mr. Chair and members of the council. We'll be on page 361 of your diligent book. And I'm just going to go through a brief history and current status of the investment program, and then Kristen will dive back into the risks and opportunities, along with the policy changes that are being proposed today. So on page 361, we're starting out with an overview of what even is the client investment program. I apologize, it's hard to look at you and have the microphone in front of me as well. What is the client program? And it was designed and intended to be high quality, low cost investment programs for state agencies. Now, the statute expands the definitions of what state agencies mean, and you'll notice in the proposed IPS language, we're looking to replicate that same definition of what statute identifies as a state agency, but it includes what you would typically think of as state agencies, as well as local governments and higher education institutions in general. This program was created in the 1990s. It was a way for these entities to have investment options available to them that they would not be able to have anywhere else for the same cost and quality. And it was a way for those agencies to participate in SIC's economies of scale. Now, one thing that I will note for the council, that when this policy was enacted, when it was passed in statute in the 90s, at the time, we were only managing just the land grant and severance tax permanent funds. This was before even a water trust fund or tobacco. Those were our only two permanent funds, assets under management. And we were almost entirely public assets. At the time, did not have the significant complexity that comes along with private assets as well, nor all the additional funds that we manage. Our first client was the Retiree Healthcare Authority in 1992. And since then, we've added a significant number of clients and have grown over time. We're now at 23 clients invested across 46 funds as of June 2026. This represents about $3.2 billion within our total portfolio, and that's roughly a little more than 4%. So who can participate in this? It does say that it has to be state agencies as identified in statute, but also in order to participate in our funds, the statute requires that they have an investment horizon of more than 1 year. We agree with the legislature that any short-term investments for participating state agencies should be directed toward the state treasurer's office where those funds belong. But for those long-term investment horizons, if agencies are looking to participate in our various investment pools, they have an option to do so through a joint powers agreement, which they do have to set up with our office in order to direct how they want those asset allocations determined. Clients are required by policy or by the JPA to set their own investment policies, their own asset allocations, and direct their own rebalancing activities. They are required to retain a qualified investment advisor to help them set that asset allocation that is required in the joint powers agreement when they set that allocation. And they let us know which of our investment pools they want to participate in, what they want that preferred asset allocation to be, and then they have the ability monthly with us to withdraw funds through our standard monthly rebalancing process. Though again, we do recommend that any actual withdrawals be sporadic, since these are not intended to be operational funds. They are intended to have that long-term investment horizon, and just like our funds that we manage, we typically only make annual distributions, and so we prefer that clients use these funds for not withdraw funds for that less than 1 year period. Now, statute does also require that clients pay at least the direct cost of services. And this is an important clarification and one that we're looking to also address in policy as well. Statute says at least the direct cost of services. The way that's been interpreted heretofore has been the pro rata share of management fees that are applied to public assets, the same way that we pay management fees through our budget. Clients also participate in their pro rata share of those public market management fees. That was roughly 2.5 million across all clients for fiscal year 26, if I'm referencing the data from our CFO from our SIC meeting. So the growth of this fund, you can see if you look at the timeline here. From when it was first established in 1991, it grew to 500 million in 2010, reached $1 billion in 2017, and is now at 3.2 billion. And we think with that 4% allocation, it's time that we would revisit and address this in policy. If you turn over to page 362, you'll see who our current active clients are. We do have 23 active and participating clients, only 5 of which are participating in any private market pools, and there are additional requirements and restrictions for any kind of allowance to participate in private market assets. Most participate in our public pools, and you can see the growth over time. And one of the things that has additionally complicated management of the client assets has been the addition of 12 more permanent funds that we are required to manage through our own asset allocations, all within different longevities, different liquidity needs, and different investment profiles, as well as our long-term expansion of private asset participation. So the client participation does significantly increase the complexity that we have to manage. And as of this last year, we've dedicated 1 accounting staff in order to facilitate the accounting complexity with managing client assets and making sure that we're processing their rebalancing activities accordingly. We are also looking at expanding our various technological services on our accounting side, platforms that can help handle this complexity and help with unitized accounting. So as we're looking at these additional costs of expansion, we are looking at revisiting the investment policy, and I'll turn it back over to Kristen to discuss that.
Chair and members of the committee, thank you so much. Coming in with a little bit of a fresh eye on this, and also having experience in the pension industry, where we will also oversee allocations like a deferred compensation program. When I came in, our team was already looking at the benefits and risks of this program. And I think it really has escalated the conversation. So if you move to the benefits and risks slide, which I don't know which packet I have, so I can't give you 364. The first thing we're trying to do is 100% understand, recognize, and acknowledge the benefits of this program. So there is no disagreement here that this is providing in-state clients access to the highest quality, lowest cost institutional investments that they can have. It aligns very closely with services provided by our state treasurer's office and allows for a longer tenured investment period. These clients are gaining tremendous cost efficiencies that, frankly, no other clients could receive if they were looking for other investment advisory services. And we also recognize that the benefit of those larger scale, more sophisticated investments being presented to these portfolios really does serve a public service, right? Our agencies are stronger because of us. Now here I come in as the new CIO with an eye toward risk, and I see the growth in these assets, which I think is fantastic. But I also recognize that that growth creates a concentration risk within our assets under management. These are clients that have very different liquidity profiles. They have very different needs overall from a budgetary perspective. And although the benefits are very strong, allowing this program to grow too large could create a bigger risk for the overall permanent funds of our portfolio. So that's one of the first risks. We talked also about the complexity of these larger scaled investments over time. We've explicitly dedicated internal resources that are covered by the budgetary needs of the State Investment Council to administer these programs. Many of us know from coming from a world where we also might have managed deferred compensation plans, statutorily, we should not supplement other agencies. So understanding that there is a bit of a supplemental divide here that we need to establish, I think is very, very important. And then I think the last is a prudent investor one. So when we look at these investments, they run the gamut in scale of in the range of sophistication. We have very sophisticated, very active clients in our portfolio who have investment advisors who are rebalancing their portfolio. That's more of the exception than it is the norm. When we're looking at these allocations, our agencies actually have more limited scope and resources. They likely aren't actively managing their investments as much as actively as they should, and they need some support understanding what their risks look like. So as we move to the next slide, we're talking about the future vision of this program, and I want to be very, very clear here. What we're proposing is not implementing the future vision today. It's recognizing the benefits and risks of this program and understanding where we can take this. Our lawmakers have shown particular interest in access to these types of investments for our external clients. We want to provide best-in-class service for these external clients, including improved client engagement, awareness, reporting. We do believe that without stepping into an investment advisor role, we can utilize the resources that SIC has to be able to allow for more prudent investment guidelines, more systematic rebalancing functions. And we can do that at a level of administrative costs that would be fairly low compared to the industry. So our largest focus here is we have a vision for this pool of assets, but we recognize that it can't be too large because it would create a liquidity and concentration risk for our total fund. And we also recognize that there is an implicit cost here that we are supplementing in order to be able to administer these programs. So if we shift over to the red line policy statement, we've given you a sample of language that we would like to be considered today. So first is that top section is just the current language as it sits today. And in CIC, Don very intuitively let us all know that this was established in 2011 and has not been revised since that time. So at minimum, it is time for us to dust off this policy. Next is, this is a large scale of capital and it should have its own place within our policy statement. So we've created a third-party client section within here. And we have started working on kind of investment policy best practices, bringing first the authority to the table, recognizing the benefits of the program from a council level, acknowledging the risks of the program from a council level, and then proposing mitigants to these risks. So I think the two main ones in terms of mitigation of risks are first, we'd like to explore the conversation around charging an administrative fee to bear the costs of administrating these functions. And second is we'd like to establish a level in which these funds cannot exceed, where we would have to slow the program down in order to not compromise the liquidity or concentration risks of our portfolio. I know you all have read this. I don't want to go word for word. I think that that is the best summary of the provisions that we're proposing to you, and I'd love to answer any questions you have.
And so just for the members' benefit, based on our discussion last week, so your intention would be, if we approve this policy, to sort of go forth and develop some thoughts around what that fee might be, what cost that might cover, and bring that back for approval at some future meeting.
Chair and members of the council, yes, thank you so much for bringing that up. We had a long conversation. We're not making decisions on costs right now or any sort of enhancements to the program. What we're doing is revising our policy to acknowledge the risks and benefits of the program. And this revision will allow staff to go back, do the research, and come back to you all with explicit approvals for how to administer a program, the costs associated with it, and how we best can enhance services for our clients.
Okay, thank you. Are there questions on the proposed IPS revisions or the client program update?
I do.
Okay, Madam Treasurer.
Quite a few. I'll just talk for all of us. Okay, so I listened to your guys's information, so I tried to get as many answers as I could prior to. But just a couple of things. Did you inform the clients that we'd be talking about this today?
Chair and members of the council, no, we have not.
Okay, so I really believe that they should be informed that this is a discussion point that's going to affect them, and they should be here to be able to give public comment. Are SIC doing quarterly or annual reports with the clients? I know Charles goes to retiree healthcare, but I don't know about all the other clients that are on this list.
Mr. Chair, Madam Treasurer, typically, we go on demand. And so, like with RHC, our largest client at 2 billion, they get a report from either myself or Dawn every 6 months. And that seems to serve them well. There's a very large, difference from the less engaged clients and those, some of them we haven't talked to in years.
Great.
Chair and Treasurer Montoya, we also do provide fund reporting to our clients. So that is an outsourced service that SIC is supplementing the cost for. They might not see us in their meetings every quarter or annually, but they are seeing performance reports and reports of balances from us on a regular cadence.
So, Mr. Chairman, I don't know if anyone from this council has actually read one of the joint powers agreements, but I think that would be a great thing to give to the council to be able to see what that looks like in the interim. I have, because I'm on retiree healthcare, and ours is a really good joint powers agreement. It does require that SIC does come at least, I think, once a year. And so Charles comes and gives a report, or before Charles, someone else would come and give a report, and that's helpful. Where do I want to go from here? So I saw state agencies and the red line took out local governments. I looked at the statute on 6871 and I'm not seeing where it says state agencies or local governments on that part. Can someone help me and direct me where exactly it says that portion? Because I knew local governments could invest. I didn't realize we have state agencies, including CYFD. So can you just help me which section that is on 687?
Mr. Chair and Madam Treasurer, so the definition within 687I, it's specifically item I under 687. And that statute defines state agency. We also replicate that definition directly from statute into the policy here. It's a footnote on the policy of the definition of state agency, where it defines as any branch, agency, department, et cetera, including subdivisions of the state. So that would be local governments as well as educational institutions.
Thank you. I thought that was a 1. So I couldn't find it. All right. So, Mr. Chairman, the next question I had is, and Dawn sort of spoke about it, or Kristen, but how much is direct cost of services? And I heard the pro rata shares. And I also heard on the video, member Tejas asking the same question. So I didn't know if you guys maybe had an update of how much are we actually charging all of them for the total of the 2.3 billion that is in that bucket.
Mr. Chair, Madam Treasurer, for FY26, the total came to about $2.5 million. And again, it's a pro rata share. So each fund would, or each client in the fund for under each client would participate in their relative to their size.
And Chair and Madam Treasurer, just to clarify, and I'm sure you already know this, but that $2+ million really only covers the cost of the management fees associated with our investing. So that does not cover any sort of reporting functions, SIC staffing functions, or any operational support at this time.
Mr. Chairman, is that about 10%? Or how much is it in basis points?
Less, is that 10 basis points or 3 to 4 basis points?
2.5 million, 2.3 billion.
4.3 billion, I thought.
Is it 4.3? Let me look. Wait, say that again, Miss Marywoman?
It's 3.2 billion, 23.
Let me go back to Marcia's.
And I am quite terrible at math on the fly. I'm not going to try, but we certainly can get the basis point number for you. Once again, those are explicit manager fees.
So, Mr. Chairman, beginning market value 2.8 with everything that happened. We're at 3.2 and 4% of the fund. So 3.2 billion. So I think this will be helpful for us when we talk about this next month. 3.2 billion. We charged 2.5 million, and that's just the administrative fees of whatever fund they're in, paying that cost off, right?
Mr. Chair, Madam Treasurer, just math on the fly here, it looks like less than a basis point.
Okay. I heard a lot of comments about having an FA. I didn't remember in the joint powers that local government should have a financial advisor. I didn't, so Class A counties usually do have a financial advisor. Class A counties are your big five. But a lot of times, I'm going to put on my county treasurer hat for a second. A lot of times, it's always been stated, if you had more money and you can do something more long-term, check in with SIC. And it had to be at least 5 or 7 years before that you don't need this money. Everything else they'd say to put into the LGIP, which is with the treasurer's office, short-term liquidity. They can literally take it out in a day. Or 48 hours if it's after 1 p.m. I have to always put that disclaimer. So with the FA conversation, I heard that it was on the joint powers agreements, which is why I really wanted to see what that looks like, because I think it is important, but I know a lot of smaller communities don't have the money to pay for an FA. If they did, they wouldn't be putting your money with SIC. And then I also heard a conversation about percentage versus basis points. Counties and cities are used to basis points, so that might be a great idea instead of a percentage so that everyone knows exactly what they're paying on to. I think Member Tejas had mentioned something like that, and I absolutely agree, because for counties and cities to budget, it's important for them to know what that percentage is going to look like, and they're used to it being in the LGIP. Program design, and then asset allocation. I was a little bit confused about when they're deciding to be a client, what does that look like for them? Do they come in sort of like a 5 to 9 and say, your risk profile is this, you have option A, B, and C? And if they don't, maybe that's what we need to do too, to make it easier for them. Like, this is if you don't need to touch this money for 7 years, this is what bucket you should be in, more or less. I also heard, and Evan was very clear, we don't give advice to others, and I think that's great. I think a letter to these people that we're saying, we're talking about this, we're reviewing it, we'd like your input, should also say, for those of you who haven't touched this money and done anything with it, you need to look at talking to an FA about rebalancing, because I heard a 90-10% split. It sounds scary. So that would be important for them to do. And then making sure we add in local governments into this, and maybe putting that part of the statute portion, because it was taken out, even though it's in the statute itself.
Mr. Chair, Madam Treasurer, local governments are included in the footnote of the definition of state agency, which includes any institution or political subdivision of the state. A political subdivision of the state is local governments. We were just including local governments rather than saying that explicitly. We're just replicating the statutory language, but it's not taking them out.
And Mr. Chair and Madam Treasurer, if I may answer a couple or make comments on a couple of the points that have been brought up. The first is the need for a financial advisor. So State Investment Council has never represented themselves. Chief Investment Officer, its investment team have never represented themselves as investment advisors to the public. So there is a requirement for a financial advisor in all JPAs right now. The challenge right now, though, is we've got our more sophisticated clients who have their financial advisors on retainer and are continuing to monitor the risk profile of a portfolio. And then we have our smaller clients who may have at one time hired a financial advisor to opine on asset allocation to enter into the program and has not continued with that review. And that's where we skew into kind of the lack of rebalancing, potential concentration risk as the portfolio skews. So that is one of the risks. What I will tell you is when we're talking about our enhancements for our clients, we're also hearing that our agencies don't have the money to hire a financial advisor. It would be a much larger fee for them than it would be for the State Investment Council to utilize our advisors. And so a future state that we would, of course, bring to you all for approval would be what Treasurer Montoya has talked about, which is modeled or balanced portfolios that are based on liquidity, time horizon, and risk profile. You've seen a little bit of that today in our performance review, where we do that with our endowments already. So you see the different risk profiles that we have, and we believe that we could leverage the resources of our investment consultant and those approved asset allocations on a risk profile basis to help those smaller state agencies. Now, all of that comes at a cost, as you can imagine, and that's why we come back to the conversation around the need for a future administrative fee that will support these enhancements.
And Mr. Chair, Madam Treasurer, if I may just add one additional comment to your question on whether or not local government, or excuse me, whether any of the clients have been notified that this was being brought up for discussion for today. The reason for that answer being no is because we don't want to put the cart before the horse and go talk to clients before talking to the council. We think that bringing this issue to the council is the first place that it belongs. And we do want to highlight, as Kristen highlighted before, this language makes no changes to the current program. Absolutely none. All it does is open up flexibility for the council to approve changes in the future, should it so do so. One thing I'll point you to is in the underlined language on page 366, it says the NMSIC may require agencies. The NMSIC, as represented in the investment policy statement, is the council. The council may require those costs, not staff, not the state investment office. Any changes whatsoever would have to be brought to the council for consideration, would have to be notified on the agendas, and absolutely client participation for public comment would be welcomed. But we do think that the first place to bring this before consulting with all of our 23 clients around any potential changes is to first bring this policy for discussion to the council.
So, Mr. Chairman, I respectfully disagree because the documentation says to require agencies to pay at least the direct cost and such services. And then on the second page, it says the client program shall not be subsidized directly or indirectly by the permanent endowment, shall not impair the NMSIC's, So we would be forcing our own arm to make the change without having first spoken to the clients that are going to be impacted by it. So I think it is putting the cart before the horse because we didn't inform them that this was even an agenda item that's going to potentially impact them. So I think there was a page that had the actual breakdowns. Does somebody have a copy of it to put on the screen? And I can't find it in my packet, I'm sorry. There was a couple of these third-party client funds that came up, and I don't know who some of these are, like the CYFD Next Generation Fund. What is that? Because I don't even know if it has money in it. I know it came up during the legislative session because we were going to try to create a baby bond called the Next Generation, and we realized this fund already existed. But I think it's important to know what these funds are and who these clients are. I saw a couple of them that only had $2,000 in them, and I wanted to make sure it was 2,000 and not 2 million, but the CIO's
200.
was 200,000 the lowest.
Springer has a couple of like grant that they use that for scholarships.
Okay.
And Mr. Chair, Madam Treasurer, the breakout is on page 400. It's in the July investment holdings report, where you can see all of the asset allocations and total market values for all current clients and their underlying funds. The Next Generation Fund is a statutory fund that I could look up the statute for its exact uses, but it holds $3.5 million right now.
And Mr. Chair and Madam Treasurer, I think the reading around shall not be supplemented by the State Investment Council and shall not impair our responsibility to our permanent funds. That really is less about making any changes right now and more about making a fiduciary statement around not supplementing other agencies, which is against statutory allowance.
Mr. Chairman, can you clarify that last part, which is statutory allowance?
So no agency can supplement another with their budgetary financials. And right now, that's what we're doing. So by making the statement that SIC will not supplement this program, which is supplementing other state agencies, and will not impair our ability to invest on behalf of our permanent funds, that's within the scope of our fiduciary responsibility and statutory requirements. So it's not making a change to the program. It's defining that we have a fiduciary responsibility to our permanent funds first, And we've got the duty to segregate these responsibilities. And Treasurer Montoya, you see this with New Mexico Para. I know you sit on their board as well. 457B or Smart Save has a similar statutory requirement where New Mexico Para cannot supplement the deferred compensation program because of that statutory requirement to not supplement another state agency.
Mr. Chairman, I heard that for the second time. I don't necessarily agree that that is the same thing as counties and cities and state agencies being supplemented by a permanent fund that is part for state agencies and governments. And I think that's more of a conversation, which I greatly appreciate that you're bringing forward for us to have. I don't necessarily think that what we're doing is anything wrong. And if we have been doing it wrong, we've been doing it wrong since inception, to your point that we haven't touched this since at least 2011. So I don't want to jump the gun, and I don't want to create chaos by approving something without being a little bit more thorough about what it is that we're doing. I don't agree with the percentage. I think basis points would make more sense. I think it's important for this council to know exactly how much we're paying. So like the spreadsheet, I could have sworn it wasn't in my dreams that there was a list of each one of these with a dollar amount of how much is in each one. And then how much they're paying in fees. Because I saw some of these are like Charles mentioned Springer. Springer is itty bitty. It almost sounds like we have $75 million, but we're going to pinch every penny out of you little counties and cities. It just doesn't sit well with me because the whole point of the permanent fund is to help people with rainy days. And so anywhere else, I'd be like, yeah, absolutely, they should pay way more. But in this case, it's like you're flowing like the end of the rainbow with the golden stuff with all this money, but yet you're trying to pull in more from local governments that need the resources. And so I also, if the idea was, okay, but we don't have enough money to sustain, the legislature is also giving you like a golden black thing with the leprechaun pouring more money, like however much money you need to get this job done, just do it. So I feel like the legislature would absolutely be okay with you hiring 1 or 2 more people to work on this aspect with local governments. Make it clear, like 5 basis points, that's what we're charging. I could absolutely charge more money. This conversation already took place internally. I refuse to charge more money because it is helping local governments to provide for schools and hospitals and roads. And so, and the money doesn't even go to me anyways, because the legislature takes it and throws it in the general fund. So I just feel that we need to be a little bit more thoughtful about this. I greatly appreciate that you brought this up because we do have to look at it, and you putting on your fiduciary hat, that's exactly what we need you to do. Putting on my elected official hat, I also need to look at the fact that robbing from Peter to pay Paul when it's all from the same bucket to some degree, does that make sense? Is it good for us as a council to do that, especially if it's for schools and local governments? I'm just not sure. CYFD.
Thank you for those comments. I'd like to turn to Member Sanchez, give him an opportunity to ask any questions or make any comments.
Yeah, there'll be a question at the end of this, but in the perception of, I think this is again becoming an issue. Well, I'll put on my public hat, not elected hat, perception issue rather than a policy issue. And it's okay that if we do care about how the public perceives us, but I don't think we can act just on a perception issue when we know that the statutory creation of this was very clear that we cannot subsidize. And after being I know about battles about where money's going and not going for a decade battle, that as an agency and an organization that has a fiduciary, if we've been breaking the law, then we got to stop breaking the law. We're not to subsidize any other form of government agency or state agency in any way in the fiduciary. This isn't making a change. I think you have to start somewhere, but I think this is where you start by stating the fact and the data that we will give to the public and to those who are placing money in our trust. Then we come to the table and say, what are going to be the percentages? What is the fair and ethical issues? But to pull this out of the perception the perception movement or vote, I want to stay away from that. So I would appreciate this at this time so that we can start the ball rolling for those who have trusted us.
Mr. Chairman, on that point,
Madam Treasurer.
we are charging them a fee for the cost of doing the investment. We're just not charging them an administrative fee for the work and the labor that the SIC team is doing on their behalf, correct? So like if they have a fund, they're in the private equity, they're paying that fee on that part. So that complies with the current state statute. It's the administrative fee that on her end, she's believing my people should get paid for doing the work on behalf of all these other people.
And
so we are in compliance. It's just more of that you're wanting us to be, you're putting your prudent hat on of saying, hey, we're doing all the labor, but we're not getting paid for it.
Well, and Chair and Treasurer Montoya, it's less about getting paid. It's about paying back the State Investment Council for the administrative responsibilities of of executing these funds. So this is not a money-making business. We also would not expect this administrative fee, which we will come to you and will review with you in prudent recommendation standard, to be high. But let's acknowledge that dedicated SIC resources are administering this pool of capital. So outside of just what it costs to invest with the manager, there are costs that SIC is bearing. And I'm not suggesting that we're breaking the law, but I am suggesting that not recognizing there's implicit costs here could be a little bit of a misstep for us. And we should consider whether or not one, those costs should remain solely borne by SIC on their budgetary burdens. And two, if we can continue to afford to enhance that client service component while also bearing the costs of this program. So I think there's opportunity and there's risk here. And I want to highlight both to you. As Treasurer Montoya said, it is my responsibility to come in here and highlight where our risks are. I fully understand that this feels like we might be imposing an imposition on our smaller agencies. What I will tell you is I don't believe it'll be a large one. I don't believe that it would be egregious. And I do believe that we can still continue to offer a great service and an even more enhanced service going forward for our clients. So happy to answer any questions or take any more thoughts.
Member Summer.
First of all, thanks for bringing this to our attention. And the language you're proposing, from my perspective, doesn't seem to change anything that permanently or make any policy change. I do think it's important that we analyze this particular program, that we analyze its costs, and that we have a full understanding about how it impacts investing generally, portfolios that you may want to offer to clients, and what that position it puts us in as a fiduciary, and why we want to do it and for whom we want to do it. I'd like to see a copy of one of those agreements just for fun, just to see what it says. But I don't see this language as being a policy change. I think it's more of a clarification, and I think it states basically what the law is. So I don't have a problem with it. So I'm okay with voting on it today if you want.
So, Mr. Chairman, on that point, then what is 7%? Because if we don't have any numbers and we're saying 7%, we don't know how that negatively or positively impacts the total or each individual one. Like, what if you just have people from the school for the visually impaired or handicapped come over here and tell you guys that we screwed them over? We don't know because we don't have a dollar amount. So that's why I'm saying before we jump the gun, we have time. We've done this. We haven't fixed this since 2011. Why don't we get the numbers, get the information that we need, get them the joint powers agreement so they can see it, because he's a lawyer, so he'll love that part of it. I had to say that for you. And then see what the dollar amounts are here, because I think there was a couple things I saw. One, there are some people that probably just need to pull their money out because they're not using it wisely, and they should probably put it in LGIP, or maybe they have a financial advisor doesn't realize this is even on their books and they should invest it outside sourced. Two, maybe we should look at parameters before we allow more people to come into SIC. You have to have at least 5 years that you don't need the money, or 7 years, whatever your magic number is, and it has to be at least whatever number. The reason why I'm thinking that is that workforce bill that should have never came to SIC, and I saw it on there. It's like ridiculous. Not that it's a ridiculous fund. It's not supposed to be at the SIC is what I meant. So I feel like this was great that she brought this to us. I just feel that we need more information to make sure we don't have any unintended consequences to any of the people that are our partners in the process.
Would you like some clarification on the 7%? Because that's not a fee, right? That's,
I would like to bring that. Thank you so much, Chair and Member Montoya. I appreciate the opportunity to clarify. That 7% is a limit of the level of external client accounts that the total portfolio can absorb. This has nothing to do on imposition of cost. It really is a risk management mechanism imposed by council to ensure that we don't have a concentration of external clients who don't align with our long-term liquidity goals and our long-term budgetary goals. So this is in no way imposing any sort of cost to any of our clients right now. This is a portfolio management function only.
it's also somewhat hypothetical, correct? Because we're currently at around 4%.
That's a great point.
Revisit it as
Correct.
we approach
And,
that.
and Mr. Chair, that 7% on our current balance would be roughly 5.2 billion. We're at 3.2 billion today. So we're at 4%. The limit would be at 7%. That would allow substantial growth within the just total clients that we take on, but it is establishing a limit of how much of total AUM we think the SIC could absorb. And again, because it's on a percentage basis, as our AUM grows, the actual dollar amount would grow with that, so that at no point should it make up more than 7% of the portfolio.
Thank you. Thank you, Mr. Chairman. I apologize for that. I think it's more sorry, I mixed that up with the front of the sentence on the shall not be subsidized directly or indirectly. What that percentage might come up to be based on your analysis, because we don't know what it is, because we don't know how much we're subsidizing. Is 5 basis points the right answer, or 7 basis points? I don't know.
And Chair and Treasurer Montoya, that specific detail will be reviewed, researched, and recommended to you all in depth. And the council would have to adopt that basis point cost. So we don't have that picture for you yet. We will. And it's on our work plan for the council more broadly, so we can look at the portfolio options. We can look at the administrative costs, but at the end of the day, it's the council's duty to adopt or not adopt that implicit cost there.
I'd like to turn to Member Roman. Do you have any questions?
Thank you. I do have a comment, but I also was trying to call on Evan through you.
Oh, well, I think the question's been answered.
Okay, so my only comment is how I read this from the investment committee meeting last week, where we had, as you know, a rigorous discussion. This needs to be reworked in its entirety. It's been stale for 15 years, too long. So the risk is not only to us, but it's also to them. You look at a library district, they don't know what they have. So they look at a statement maybe every 6 months and it's gone up. They think they're okay. So I think you're asking for us to do today is give you permission to go to work on this and give us the numbers we need to make better decisions.
Chair and Member Roman, that is correct. This is council opening up the conversation for us to assess how to enhance the program and how to measure those costs associated with administering it now and enhancing it in the future. No action will be taken outside of that.
So, Mr. Chairman, because I don't know what that percentage would be, I still have concern about the shall not be subsidized directly or indirectly, because what if it's far exceeding what they can afford? And I don't know, because I don't know what the numbers are. And I also still believe that depending on what that number looks like us subsidizing 1 basis point, when you guys had a reversion of 3 million and you guys are asking for another 9 million, I don't know, it just feels not so good.
And Chair and Treasurer Montoya, Member Tejas brought up a similar concern. And the one thing I pointed out is this is actually a risk as well. So having a pool of clients that have different fiduciary needs, different liquidity needs, different budgetary needs, The supplemental component of it is a risk also that we need to consider from a fiduciary standpoint. So I hear loudly and clearly what you're saying. I'm highlighting a risk to you all for us to understand further. And I think John has some comments he'd like to make.
Yes, thank you. And Mr. Chair and Madam Treasurer, just to add on to this, I view this statement, this proposed revision to our policy statement before you as just clarification of our existing fiduciary duty. In the enabling statutes for both of our permanent funds, it says that we have a fiduciary duty to these funds and that we are to seek the highest risk-adjusted returns. These permanent funds are where our budget comes from. So if we are subsidizing anything else, it is at the expense of the beneficiaries of those funds. Now, the severance tax permanent fund doesn't have a clear beneficiary other than the general fund, but the land grant permanent fund has very clearly defined beneficiaries. They're defined in our state constitution and they're defined in federal law. They each have a very specific percentage ownership of the value of the land grant permanent fund. And so it's not just the same money. It's not that's a pool of money that is available to the state more generally. They are very specific beneficiaries. I just wanted to make that point.
Thank you. Are there additional questions, Member Tejas?
Yes, Mr. Chair, council members. I was curious, if you could refresh my mind, maybe Evan, on what is our protocol procedure process for revisions to the IPS? How does that usually happen?
Exactly like this. The IPS is brought to your attention to make.
Have we ever considered, Mr. Chair, first and second reading of a change to such an important policy?
When you say first and second reading,
Meaning, first reading, it comes to the council so we can have a first look at it and then we can have conversations. And then if any kind of revisions are similar to a third reading with the legislature, so that it gives us a chance to hear an initial kind of discussion, go back, make some considerations, even vet it around some of the committees. Because while this is a CIC issue, but it is also a governance issue, I think. And you could float it through that process and then bring it back here for an official second reading vote.
I mean, I speaking for myself, I can certainly remember meetings in the past where, items have been brought that people weren't quite ready to vote on. I think there have been tabling motions in those instances,
I would like for us to consider in our policies, Mr. Chair and members, if we could do maybe a first and second reading type process so that, changes to the IPS is a big deal to me. And it seems like recently we've made quite a few, more than what I would say is occasional. And Kristen's new, so I'm not surprised that you're seeing things, and I do commend you for looking under the hood and bringing to our attention the things that we need to look at and adjust if needed. But yeah, if we could maybe consider that somehow in a future meeting, first and second chance at looking at IPS changes. I just feel like we've made revisions more frequently than I would want to see to such an important policy. I think that occasional revisions to it is reasonable, but 3, 4 in a year, I don't know if that's something we want to do. It's not something I'm really that in favor of. So with that, I'd like to see if we could get maybe have this come back if members are amenable to it, because there are a lot of issues, and it's this is while it might seem pretty innocuous, there is language in there that I think we need to look closer at. So I would appreciate it if that if the council is willing to consider that. Yeah.
I think Mr. Clark had a comment on in
The-
response to that question.
Thank you, Mr. Chair and Member Tejas. So I would say part of the reason why we're having to come back to you frequently with changes is because of the length and detail of our investment policy statement. One thing that we've been looking at is what investment policy statements look like for other allocator organizations. Ours is significantly longer than many of them, and it gets much more in detail, much more in the weeds. Others provide more broad frameworks. And when you have a broader framework, it's not as necessary to come back frequently with changes. I think because ours gets so in the weeds and because we are going through such a period of rapid change, it becomes necessary to do that. We are planning to bring forward to you in the coming months examples of what could be considered some best practice investment policy statements so you can see what other organizations are doing in that regard.
Okay, Ms. Varela also had a response, I believe.
Chair, thank you so much. Member Tejas, I also appreciate the feedback. What I will tell you is, yes, we've got a large scale review of our investment policy statement that we should look at. When you see a large operationally oriented investment policy statement, what you're definitely going to find are inconsistencies in that statement. I'm not even starting that piece with you, but we will work on that together. And for that, Member Tejas, you will actually see 3 working sessions. So first read, second read, third read, and even an educational component so that we understand what the best practices are. So I hear you on the read component. What I will tell you is this is a clarifying revision within policy to allow us to do our work to bring more actionable items to you. We saw that first read in the really healthy debate in CIC, and we're now bringing it to council. And what I would respectfully ask is if we are going to table this, I would like some actionable takeaways that we should work on so that we can actually come to a place of final decision on this.
Mr.
Thank you.
Chairman, I would absolutely appreciate what that cost is actually going to be with the breakdown of each entity that you work with, how much money they have, and then what they currently pay, and then what they would next pay. Because this might be a nothing brainer, but I don't know because I don't have it. I don't have it in front of me to know what that considered direct cost would be. That would make me feel a lot more comfortable personally. I think that's the biggest takeaway for me on the wording and on the percentage.
Okay, Member Sanchez?
And trying to stay germane to what you brought forward, the cost isn't pertinent to this conversation at all because we don't have the ability to waiver from the law to say, well, it's a little amount, so we can let that go. It's either one or the other. So that's not germane to the conversation, I think.
Mr. Chairman, it is germane because there's a difference between the cost of the direct services and the administrative fee of what you're deciding should be charged for that person's work on that deal.
That'd be helpful, perhaps.
Mr. Land.
And I think I'm kind of compelled as your lawyer to speak up at this point. Staff is not determining anything. You said, because you just made a statement about, you're setting forth your cost. What we decide? We're not deciding anything. I'm a little cautious, and I think I wanted to go back to sort of what I heard today because I want to talk about what didn't happen because there's been language used. I've heard ridiculous. I've heard starting over. I've heard stealing from Peter to pay Paul. I've heard breaking the law. I've heard feels not so good, and I've heard other statements along those lines. I don't respectfully think that any of that is supported in fact or is the record, and I don't think anyone meant it as such. What I have heard is a very qualified, your new CIO has come in and said, I think I have a fiduciary matter, and I think I have a risk matter, and I think we need to talk about it. And I think that's actually exactly how this should work. And then that CIO said, well, I want to work with you. I want direction. If you want to do it that way, that's totally fine. And that's however you work it out. That's great. But this is exactly how the council should work. We should not go when we think we have a fiduciary risk matter to 23 clients first and see what they think. We need to come to you as fiduciary, as overseers to deal with that. And this is the first step. And I understand that there's language here that may concern folks, whether it's of how it's viewed, and we hear you. But what we aren't resolving today is what is that plan to deal with what has been brought to you by your qualified CIO to say, this is something we need to discuss. And if that's where that's headed, great. But for the record, I just wanted to get on and say, we're not breaking the law. We're not hostile to clients. We're not doing things that don't feel good, and so on and so forth, without harping on things. I just think that some very valid points have been made. And I would encourage the council to just say, this is a fiduciary matter that was brought to us today appropriately. Do we want to deal with it today, or do we want to deal with it next time based on some very distinct parameters? And either that is within your purview, whether it's second or third. But I do feel, as your guidance, as your legal advisor, that you have been given enough information today to proceed. If you elected not to do so, that's your decision.
Mr. Chair. Yes, thanks, if I may. Thank you, Evan, for that. I think that that really is important to clarify that this is new information. We've been operating for years and many years with the program, within our understanding that everything is comporting with different requirements. And so I think that's an important statement to make. But if you can help me, Evan, if you are going to change our procedure to bring things back second, third reading, how soon would we do that? How does that look? Like what is that?
Staff has not changed your procedure, respectfully, Member Tejas.
Yeah.
The council has always had the right to effectively table something, and we've seen that repeatedly.
No, but if I may, Mr. Chair and Kristen, I thought you said, Kristen said that.
Kristen said that there will be a review of the IPS once we have an educational process, and she wants to build in a complete consensus thing for detail. So let's step back. The IPS has been updated a couple times recently. They've all been technical updates or structure studies. And so what Kristen's talking about is, how do you want to operate as part of her being CIO? And so she wants to ensure that when you do that, you will have, I think she said 3 or 4, 3 bites at the apple, if you will, just so to build consensus and to make sure. I would submit to you respectfully, that's very different from saying, I have a fiduciary risk concern that I noticed when I looked at your portfolio. I'm not saying that the sky is falling, but there are best practices we could follow. And we think it would be prudent and fiduciarily responsible to authorize a process by which we can look at it, by which staff can make no decisions, and then we can come back to you to vote however you want to vote on every detail, every cost, everything within your purview. And that's all that's happened today. And I think we've gone way past the agenda item, so to speak. It's, may we look at this and may we get back to you in the manner that's here because we think it's important, and that's what's being said today. And so I'll stop there.
Mr. Chairman,
Madam Treasurer.
I think we should talk about this as long as we need to as a council, first off, especially because it's the first time some of us are seeing it. There's another component that I wanted to just bring to your attention that I do have some concerns about that doesn't have to do with what we've been talking about. There's a section on here that says, there was a terminate portion. It's the second page, the first real the first real start of a sentence. In addition, the NMSIC may modify, suspend, or terminate the client program as necessary and establish limits on program participation. And that doesn't sound like a big deal because that come back before the council to do. But then when I look at what's on the next agenda item, there's a new language that says the SIC delegates the SIO decision-making authority relating to contracts with state agencies pursuant to NMSA 1978, Section 687, which is the local and state agencies, and for all other investment-related and other matters. So that sounds to me like we'd be giving you the authority to just move forward with the state and local government contracts and anything that is in agreement with that. But we also have on here that now we can directly or indirectly, we can modify, suspend, or terminate the client program which is not what the statute says, so it's a little bit confusing.
Mr. Clark?
Mr. Chair and Madam Treasurer, so that language that you're seeing on the next agenda item, that particular language is already in existence. That's not a change. Really, the only actual changes, material changes on that next agenda item are to add Dawn as an authorized signer in her role as Chief Investment Operations Officer, and also provide that for some functions, our Deputy General Counsel of Amy Chavez Romero can also sign. The other changes you're seeing there are through a process of taking 3 disparate documents and trying to combine them into one, but those are the only 2 actual material changes. Everything else you're seeing there is in existence somewhere else in policy, but in this policy, which was from 2010 and has since been superseded by other policies, you're seeing us go back and make those changes to this policy to reflect changes that the council has made since 2010.
And Chair, and Treasurer Montoya, I might just add that statute actually says the SIC may provide these state agencies this service, not shall. So the flexibility of determining the sizing, the joint power agreements, the negotiations have always lived within council. We're now memorializing that in the policy so that I'm sorry, we can bring those bigger decision points to council for adoption.
And Mr. Chair, Madam Treasurer, one additional point of clarification there. Because again, in the IPS, the NMSIC refers specifically to the council, not the state investment office. This language is very specifically saying the NMSIC, the council, and only the council can modify, suspend, or terminate the client program. In fact, it is more clarification than we currently have now in policy, where the current policy says the state investment office may enter into a joint powers agreement. This is actually clarifying that it is not the state investment office who can terminate the program, the client program in general. It is in fact the SIC and only the council that can do that. So this adds more protections than less for what the council's authority is in this client program.
Thanks for that clarification.
Mr. Chair and Madam Treasurer, I do want to make one clarification with respect to what you pointed out, Madam Treasurer, in the language in the delegation of and authority policy that discusses section 6871. That provision is added, and I'll get into this at the time when I present that policy, is only included to clarify that the state investment office can enter into joint powers agreements with the clients without coming to the council each time that it enters into a joint powers agreement under the client program.
And Mr. Chairman, is that something that's already being done?
Yes, it is. It's just included as a clarification in the broader context of how everything is put together in that policy.
Okay. So what's the pleasure of the committee? I mean, I guess I've heard some comments that it sounds like there may be a preference for staff to actually go off and do the work and come back with a proposed revision of the IPS that also includes perhaps actually a fee proposal. I think there's other members who feel like, proceeding with this IPS revision makes sense as a preparatory step to allow staff to go off and do that and come back with a fee proposal, I think was the original concept.
I would prefer finding out. I don't like to get into a car and not know where I'm going. So I'd like to know what the dollar amounts are going to be for each of these agencies and what that impact looks like, so that for full transparency, it's there, and then we can agree to move forward, or what that forward looks like. Maybe perspective from staff of like how they want to do it, because I've heard a lot about percentages, but I think basis points, I mean, I know it turns into a percentage, but like figuring out what that might look like, if there's tiers.
Okay, any perspective from staff on maybe coming back and doing this all in one fell swoop with the dollars and positions and everything laid out concurrent with the IPS revision?
Chair and members of the council, we are at the will of the council. So what you all decide is what we'll do. What I will tell you is I wouldn't have brought this in front of you if I didn't think identifying this risk was important now, and having this formalized in policy to ensure that we aren't supplementing other programs strengthened our fiduciary stance. So we can table this. We can bring you the picture. We're going to bring you the picture, and you all will have the ability to approve what those costs look like. I think the first part is recognizing there's a cost and acknowledging who's supplementing that cost at this time.
And I think that's been well noted, Mr. Chairman. Move to table.
Okay, we have a motion to table. Is there a second?
Again.
Okay, there's a second. We'll have a roll call vote, please.
Treasurer Gloria Montoya,
Yes.
Nick Tias,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
No.
Kurt Summer,
No.
Mary Roman.
No.
It's 4 in the affirmative, 3 with no.
Okay, so I believe that's a passing vote on the tabling motion. It's a majority vote. Okay,
Excuse me, Mr. Chair, just so I know how this rolls here. Are we saying no, table it, don't go to work and try to figure this out? Or where are we leaving this with this vote?
I think how we should interpret this is we've tabled the motion. It will come back up for consideration, and staff has been directed to bring with that reconsideration the detail around proposed fees and costs for the third-party clients. Does that comport with everybody's understanding?
That's, yes.
And Mr. Chair and members, for additional clarification, I'm also interpreting based on statements that we also have a directive to now go out and start talking to these clients about this process.
Say so.
Okay. Without objection.
Thank you.
Okay, thank you very much. We will move now to item 3D, 4B, Delegation of Authority and Signature Policy Updates. Ms. Chavez Romero.
Mr. Chair and members of the council, on page 371 of your materials, you have a proposed delegation of authority and signature policy, which is intended to consolidate all the previous policies pertaining to the State Investment Council's delegation of authority to the State Investment Office and its policy on who can sign documents on behalf of the State Investment Council and the State Investment Office. This policy, I've included a few background materials, and so if you look on pages 372, 373, 374, 375, and 376, you'll see previous policies that are being consolidated all into one on page 371. There are a couple of substantive changes to note. One is the addition of the Chief Investment Operations Officer as a person that can sign documents on behalf of the State Investment Council and on behalf of the State Investment Office. There is also a clarification that pertains to the Deputy General Counsel's signature authority to sign documents as specified by the State Investment Officer, and only if those documents have been delegated to the state, and only if those documents are able to be signed by the State Investment Office on behalf of the State Investment Council. So on pages 368 through 370, I've provided a memorandum that goes into great detail as to what is being combined and how. And rather than go into those items line by line, I'd be happy to answer any questions on what has been transferred to the consolidated policy, or if you have any questions on any specific line items, I'm happy to answer those as well.
Okay, thank you very much. Are there any questions on the proposed policy?
I do.
Okay, Madam Treasurer.
Thank you, Ms. Amy, for the presentation. Just to clarify for me, the 50,000 got removed from number 6 and number 2 on the second section. And I see a 250,000. Are we changing the 50,000 to the 250, or are they completely separate?
Yeah, nothing is changing. Those changes reflect a March 2024 resolution that was adopted by this council. That resolution is contained on page 376 of your materials. In March 2024, the State Investment Council voted to give the State Investment Office the authority to enter into contracts that are not otherwise within the State Investment Council's statutory authority or otherwise reserved to the council under some other policy. It gave the State Investment Office the power or the authority to enter into those contracts, whether or not they were above 50,000 or under 50,000. So this policy simply strikes the references to contracts that are above or under 50,000 and doesn't change anything from the March 2024 resolution. It reflects those changes.
Okay, and then Mr. Chairman, on the second page, the last sentence, items 2 and 3 require a signature from one authorized signatory. Is that prudent? We always sign everything. There's 2 of us that always sign something for the checks and balances. So I wondered why we kept it as 1 or if it was just an oversight.
So I'm looking at the new policy, and you're correct. It says item 1, which is all investments in any contracts that have been voted upon and approved by the SIC. That would require signatures from 2 authorized signatories. The other contracts are those contracts that are delegated to the State Investment Office to enter into and are not the investments that have been approved by the State Investment Council. So those are operational type contracts that the State Investment Office enters into, and those would require one signature, and any other matters for the purpose of transacting business would require one signature. So before, in our existing policies, the State Investment Office was signing contracts with 2 signatories where the State Investment Council approved those contracts, where the State Investment Council delegated the authority to the State Investment Office. Only one signature is being made.
So, Mr. Chairman, can somebody give me an idea of what one of those contracts would look like? Because it sounds like if we approved it and you got 2 signatures, that's great. But if we didn't review it at all and you only have 1 signature, it just seems to make more sense to have 2 people in the office that know that something got signed, or what are these?
Nope, and trust us, we got you. We don't need 2 signatures for like the New York Times subscription or
Oh, is
something
that
like
what this
that.
is?
So anything that comes within your area,
Got it.
we're looking at. There's no one here looking to do anything.
Is there anything else that's real, that's not a subscription?
Not in my opinion, that's material to what you do.
Thank you. Thank you, Chairman.
Thank you. Are there additional questions? Hearing none, is there a motion? Member Summer?
Based on the recommendations of the SIC staff, I move that the State Investment Council approve the updated delegation of authority and signature policy as memorialized, reviewed, and discussed by the council today.
Second? Okay, we have a motion and a second. Could we have a roll call vote, please?
Treasurer Gloria Montoya,
Yes.
Nick Tejas,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
and Mary Roman.
Yes.
That's 7 in the affirmative. Motion passes.
Okay, thank you. We are now on item 5 of the agenda, finance matters, and recognize our CFO for the CFO report.
Mr. Chairman, thank you. There's only of the material that I've included in my section today. I'm not going to touch upon budget to actuals. The July budget is just 1 month of budget with projections through the end of the fiscal year. Not much to point at there. The July investment holdings report, similar thing with that. Not a whole lot of activity that I need to talk about, or the July beneficiary schedule. I do want to, because it's due September 1st, touch upon the fiscal year 28 appropriation request. And we're at page 435 and 436. And actually, if you go to page 436, the bottom of that, it'll help me add some color to this. If you look at the far right column, fiscal year 28, the appropriation request for fiscal year 28 is $133 million. And I was laying in bed last night and thinking about how it's changed over the course of the time that I've been here. I think the first appropriation request that I did, I started in 2012, but the first appropriation request I did was 2015, and it was about $52 million, to give you some sort of color. The other thing I wanted to emphasize on these appropriation requests is just the timing of the request for fiscal year 28. We're 10 months from the beginning of the start of fiscal year 28. We're 22 months to the end of fiscal year 28. So there's a lot of room for estimating within the request here. Fiscal year 26, we touched upon it earlier at the beginning of the meeting. If you look at that first column, that's an actual column, $98.7 million. And quickly shoot over to fiscal year 27, and you'll see that the budget request for fiscal year 27, the year that we're in, is even less than that. Let me add some color. Fiscal year 26, as I pointed out earlier, we had to get through the end of the fiscal year, we had over $26 million in budget adjustment requests to get through fiscal year 26. And you might say, well, why is that? Some of it's the timing of the appropriation request because it's done so much earlier than one might expect. And the fact that we have sometimes unintended or unplanned for inflows that come into the permanent funds. And I'd also say the investment market has been fairly strong over the last several years. So fiscal year 26 on the actual column, we actually had close to, a little over $26 million in bars that we had to do to get through the end of the fiscal year. My crystal ball isn't perfect, but we basically overshot the mark by about $3 million, and we'll revert back to the land grant and the permanent fund about $3 million as it relates to that budget. For fiscal year 27, and John might have further comments to add on this, it started in fiscal year 26. It extended over to fiscal year 27. We lost our initial bar authority that we had going into the fiscal years. Actually, for the bar authority for fiscal year 26 and fiscal year 27, we got those bar authorities at the same time because they didn't give us any bar authority for fiscal year 26. For fiscal year 27, we have $25 million of a bar authority that's already authorized. At this point in time, I can tell you without a doubt, we're going to need $25 million to get through the end of the fiscal year. We also have 5% bar authority, probably estimated additional $5 million. We might need at least half of that. So if you add $25 million to that fiscal year 27 column, you get over $120 million for fiscal year 27. It helps add a little color to the numbers in fiscal year 28. So fiscal year 28, we're adding dollars in the category 200 because, as John pointed out earlier, we're continuing to add staff. We're hoping to have, by the end of the fiscal year 28, at least 60 people. And if we can make it more than that, we probably would. Other than that, I open it up to questions. I feel pretty good about the estimate for fiscal year 28, but I can tell you absolutely for fiscal year 28, if I were to give John a number for a bar, if we don't come up with unlimited bar for the 300s like we have in the past, I would say $35 million to start. John has already, and I really appreciate this, reached out to LFC and DFA, and we're to be meeting with them in early September regarding this appropriation request. The reason that's so important, I think, is there's been a disconnect. We had to play catch up in fiscal year 27 and fiscal year 26 because they have a disconnect as to how our costs are determined. They're thinking it's more fixed cost. They don't completely understand its variable cost as our assets grow, some of it due to the market, some of it due to inflows. Our costs are going to continue to grow. Nothing's changed. It's always been like this. They just, I think they have new leadership and they're struggling to get their arms around this. So we're hoping to continue to educate them. With that, I'm open to any questions that you might have.
Okay, thank you. Any questions on the CFO report? Okay, hearing none. Thank you very much for that report, as always. And we will now turn to closing matters. Any older new business or informational items that members have?
Chairman?
Yep, Member Sanchez.
Yeah, so under old or new business and informational items, I just want to bring an informational piece. I congratulate our staff for bringing forward and educating me that we're subsidizing non-beneficiary agencies. The people of the state worked very hard to get a constitutional amendment on the ballot. The legislators worked very hard. That went to the people of New Mexico. HJR 1, the Early Childhood Constitutional Amendment, increased distributions to the K through 12 and to early childhood. Nowhere in that constitutional amendment authorized the creation of any other beneficiary. And so I recognize the urgency of what you brought forward, that if we're subsidizing any other government agency, that was not the will of the people of the state of New Mexico. And as a fiduciary, I think the tabling item that we just passed had very vague attachments to it that weren't actually an amendment to a motion in the instruction of what's to be brought forward by the staff. I'm not even clear what you're going to bring forward. So I think this is an urgent item. Should immediately go to whatever committees that I know came out of a committee. That's part of your 3 strikes. You had 1 strike already done with the committee. So on the record, I want to protect the people of New Mexico and the trust. And there was not a new beneficiary for any of those clients listed on that list at any amount of dollar to benefit them. I'm afraid of the perception issues. I know it's the election season. I'm always afraid of perceptions, but I want to stick to the facts, what you bring forward. So thank you very much for the record.
Okay, thank you. Any additional older new business or informational items?
Mr. Chair, just would like to see how we can figure out our process on sort of like our policy on policies. How we go about reviewing major changes to the investment policy and what that looks like. Would John be able to bring something back next month to help us to do that? I'm thinking that we do need to have a couple of swipes, a couple of chances at bat here on major changes to policy. And so, Member Sanchez mentioned that we may have had our 3 swings at the ball here through CIC meeting and maybe another committee, and then once it gets here, we approve it for a vote. But what I'd like to see is it comes here twice, so that we can look at it once, have a discussion, and then bring it back here for a vote. That's my idea. So however you think we can do that, I think that would be very, very helpful.
Okay, I appreciate that, but you know, in fairness, that is one member's opinion. I'm not sure all the members necessarily want to change it along those lines. You know, I do have some concerns about belaboring some of these items, but I don't know if Mr. Clark would like to respond.
May I just respond factually? Because the way you bring the policy change is what we just did today. You bring a revision to the investment policy. It actually says in the investment policy, you've already set this policy for us. The NMSIC, that's you, will review the policy, which is what we did today, from time to time to determine if modifications are necessary or desirable. And that's what's in the policy. Like, we followed today what you told us to do. And I'm not saying that anyone didn't keep their word or whatever. I'm just simply saying what you just said is exactly what's there and what we did.
Yes.
I hear you about the two things. That's a policy consideration that you could all consider. I'm not opining on that. I just think we've heard you and we will do the best we can, but we followed the policy, and this is not defensive. It's simply the ironic answer to your thing was that's exactly what was done today, as in policy compliance.
Yes,
That
but
is
if the council, Mr. Chair, if the council would want to change that policy process, I think we can do that and we should. I agree that you followed it as written right now. But I also heard comments that we need to make some additional changes to our IPS, that it's very operational. I agree. When I saw it, you know, the first time I got on the SIC, I think it's really, really lengthy. And I would also stress that we only revisit that policy occasionally, that it's not a repetitive thing that we keep doing, even if we have to make technical changes. I think that policy needs to have some sort of time to kind of, you know, produce the fruits that we've set. And it's something that we shouldn't be bringing back over and over.
Chair, if I may.
Yep, our CIO has some comments.
Is one thing that we'll do is we're diving into best practices for investment policy statements, which is at the beginning of next year. Is one of the best practices is annual review of the investment policy statement to ensure that we are allowing that policy to live and breathe as the portfolio does. So I just want to set expectations that best practices going forward will be that CIC and council will have an annual review of investment policy after we have done our working sessions and determined how to streamline the policy, just to set expectations for the entire council.
Mr. Chair.
Member Roman.
So I just want to be clear, being the newest member of the SIC here. I think we went way off the reservation today. We're holding up staff, which is so limited anyway. We're 30 people short as it is. I'm not clear when we table something, what we're asking you specifically to do. I did not hear, let's go talk to 23 clients. Why create this uproar? I thought we were voting on today. Please proceed with analyzing this 15-year-old statement, including the procedures that we want our clients to have, what the minimums are, let's look at this with fresh eyes because it's not a year or two old, it's 15 years old. That's what I thought we were coming to vote on today. So by tabling it, what are we asking you to do?
So, Mr. Chairman, as part of the tabling motion, it was clear to tell staff to bring back the data that we need to be able to make a thoughtful decision instead of just voting yes or no. And let me just make another point. I don't give a shit about campaign season. That's not what I make my votes on. I make my votes based on what I think my fiduciary responsibility is, not just to SIC, but to the state of New Mexico. Sitting on all those other boards, including retiree healthcare, where they're trying to figure out how to even afford the secondary insurance because it went up so high, are the things that are in my head that I'm just factoring in. So for me to ask for more information is no sign of disrespect to anyone else. And I think it's actually disrespectful to question a tabling motion that already won. The point was to give staff the direction. I don't think necessarily every item needs to have the 2 points. I think to Member Teas's point, it's new for some of us to have heard. You did your job. We're trying to do our job. Some of us are more comfortable than others. Whatever the majority is where the comfortability is. All it's saying is come back next month with more information to try again. That's all it's saying. And nothing in a tabling motion today shifted or changed what we were gonna do or what's gonna possibly happen. They couldn't have changed the amount on the fees at this point. They're gonna pull the data to see what the cost is gonna be. And it's already been like this since 2012. So 1 month more for us to feel comfortable in taking care of our fiduciary responsibility is prudent.
And I,
So I
I-
think that's where I
appreciate it.
stand on this one, Mr.
if you
Chair.
don't mind, I'd like to just suggest we move on. I mean, I don't think the purpose of this section of the agenda is really to debate a vote that occurred several sections ago. So I think we should just move on to any public comment. Is there any public comment?
Mr. Chairman, not today.
Okay, thank you very much. The next meeting of the State Investment Council will be Tuesday, September 22nd, and we will be here again, sounds like, correct?
That is correct.